Ladies and gentlemen, welcome to the 2020 Business Forecast and Policy Outlook. How COVID-19 and the 2020 election outcomes will impact your business. Before we begin, here are some housekeeping items. Please utilize the Q&A function on the bottom of your screen to submit questions to the speakers and panelists if time permits. For individuals who are tuning in from a mobile device, please email your questions to info@cahcc.com. If you have any technical questions, please call 916-444-2221 or email info@cahcc.com. Please tag us on your social media posts using the hashtags #SJCHCC. And now please welcome to the webinar stage, Lisa Vela, CEO of the San Joaquin County Hispanic Chamber of Commerce.
I would like to thank today's event sponsors for their support of our first virtual forecasting event, the California Hispanic Chamber of Commerce, the California Hispanic Chambers of Commerce SBDC affiliate program, Energy Upgrade California, the Small Business Development Center at San Joaquin Delta College. And I would also like to recognize our chamber champions who have committed to supporting this program and all of the programs of the chamber throughout the year. Please allow me to thank California Water Service, Comcast, Golden State Restaurant Group, Health Plan of San Joaquin, JP Morgan Chase Bank, Kaiser Permanente, Port of Stockton, San Joaquin County WorkNet, San Joaquin Delta College, Uncle Credit Union, University of the Pacific, Univision 19, and Vernon Transportation, and last but not least, Wells Fargo. Now, it is with distinct honor that I introduce our keynote speaker, Dr. Scott Anderson, Executive Vice President, Chief Economist, Bank of the West. Dr. Anderson is the Chief Economist and Executive Vice President at Bank of the West, PNB Paribas, and serves on the bank's executive leadership team. Dr. Anderson, throughout his career, has been consistently recognized as one of the top economic forecasters in the country. He was named the most accurate forecaster by the National Association of Business Economics for 2019. Scott's economic research is widely read and cited by the financial and business communities, and he is a sought-after national expert and speaker on macroeconomic issues. Scott currently serves on the board of directors for the Commonwealth Club of California, and he was appointed chairman of the American Bankers Association Economic Advisory Committee in 2012 and has served on this committee since 2004. In 2015, he was appointed to the California Council of Economic Advisors. It is with great pleasure that I welcome Dr. Scott Anderson.
Thank you, Lisa, for that warm introduction, and good morning, everybody. It's hard to believe, but 2020 is coming to a close. So before I go into my comments, I'd like to wish everybody a happy holidays and really wish 2020 good riddance, and hoping that 2021 is gonna be a bit better here. So there's a lot of cross currents going around economically, financially. Unfortunately, the COVID pandemic is still impacting not only our health as a nation, but also our finances and our economy. So I still think, even though we've gotten some good news on vaccine approvals, we're starting to see those roll out over the weekend. Moderna looks like it'll be approved soon. And there's a very ambitious vaccination program set up that, you know, the government's goal is to get everybody vaccinated by the end of the second quarter of next year. But that's pretty ambitious. So in our baseline forecast, we're actually having to make some assumptions around that. And our assumption is it won't be until sometime in the third quarter. So we're expecting things could take a little bit longer. People's reticence to get vaccinated, for example. So I'm afraid that at least in the first half, and maybe even a little bit into the second half, the COVID pandemic is going to continue to exert a pretty strong influence on our economy and our finances. We've had really good news in terms of the policy response this year, and you'll see that in my slides. While it's been a difficult year economically and financially and uncertainty-wise, the policy response has been actually quite robust coming from Washington compared to what we saw during the Great Recession. You'll see that's actually helped make things quite a bit better than they could have been. The forecast back in April and in early May were pretty downbeat. We were looking at almost Great Depression levels of unemployment. We've really come back from that sort of an outlook, but we're still dealing with, we're not fully recovered here, even though we had a strong V-shaped recovery in the third quarter. We're going to see, it's going to play a little bit more like a normal recovery, I think, as we go into 2021. Just a little bit on the bad news on the virus front. We're trending at over 200,000 cases a day right now. Deaths are around 2,500 to 3,000 a day on average now. By our estimation, we think about 20 states are either in almost total lockdown like they saw in March and April, or we're seeing sort of a mixed response in terms of business closures, curfews, and stay-at-home orders. So that's about 40% of the US economy. So back in March and April, as you remember, almost 100% of the country was shut down. This time it's more like a 40% shutdown, and it's a lot more regional. So we don't expect the economic impacts from the current shutdowns to be quite as severe as we saw in March and April, but there is a big chance here that we'll see some reversal in the progress we've made on the labor market. There could be some increase in the unemployment rate as we move into the first quarter, and I'll talk a little bit about that in a minute. But as I alluded to, the CARES Act, the stimulus, we saw from that over $3 trillion of federal support. That's about 14% of US gross domestic product, and it was about 3.5 times what we saw coming out of the Great Recession from the government. So that was really helpful in restoring, keeping businesses solvent, especially small businesses, with the help from the PPP program. Consumers, actually, some of those that were receiving extra unemployment benefits actually went out and spent those. So that really helped, get us, get the recovery started in May, and we really saw that take off over the summer and into the fall. But we're now coming up to a lot of the expirations. Congress is working as we speak on another relief package that may be part of the additional spending package that Congress has to pass before the holidays. It looks like it's going to be quite a bit scaled down from what we might have thought 3 to 6 months ago. We're looking at something at most about $900 billion in terms of additional stimulus. But we're really racing against the clock here. We estimate about 13 million folks could lose unemployment benefits starting right after Christmas as the pandemic relief programs peter out. There's about 9 million folks that aren't current on their rent. They could lose their eviction moratoriums and the mortgage forbearance. We know there's about 8 million folks or so that aren't making their mortgage payments or haven't fully made their mortgage payments. So all that's still kind of looming over us. And if we don't get an extension of some of these programs, we could see, more fallout for the housing market and in terms of the consumer spending going forward. But it looks like they are going to come to some sort of deal, and that's kind of baked into our forecast that you'll see today. We expect close to $1 trillion in additional support from the federal government. That'll include help for small businesses, like an extension of the PPP program. We're expecting perhaps another stimulus check going out to individuals, something in the $600 to $700 range, not quite as big as the 1,200 people got back in March and April. And there's expected to be extensions of unemployment benefits as well, with maybe extra payments of about $300 a week. So a little bit scaled back from what we saw in the CARES Act, but better than nothing, and certainly needed right now to keep our economy going. A couple of things that aren't Was there a question? Okay, can you hear me okay? Sorry about that. A little technical difficulties here, the joys of virtual conferences. A couple of things that aren't in the package. One is additional support for state and local governments. It doesn't look like they're gonna do anything on that before the new Congress is put in place. And that's something, and there's also probably putting away any sort of litigation relief for businesses around the COVID. Those sort of things are kind of, no agreement has been made. They're going to kind of set that aside and maybe tackle those in future legislation. So that's a little bit of a kind of a rundown of where we are today. I'm going to start with kind of the 50,000 foot level, talk about what we're expecting from the global economy, US economy, in the framework of these assumptions around the coronavirus and the government supports that we're seeing. So if we go to the next slide, we certainly saw a V-shaped bounce off of the depression level declines we saw in just a month and a half time, both globally as basically the global economy shut down. This is the biggest drop in economic activity since the Great Depression, both globally and in the United States, but we really strongly bounced out of that in the third quarter. Unfortunately, now a lot of that V-shaped impulse growth response we got early in the reopening is now fading fairly quickly as the government supports fade and virus cases resurge. But we're still seeing growth in general expected, but not as strong as we've seen over the past 3 to 6 months. Next slide. In terms of areas of the world, there's leaders and laggards. China was early to get the pandemic. They got that under control very quickly. They've also benefited by exporting a lot of their medical equipment and medical supplies to the world through this crisis. So they've actually bounced back quite strongly. They're the only economy in the world that's expected to see growth this year of around 2%. And the expectation is we'll see something at least 8% growth in China next year. That will lead the world. That's going to help in developing Asia as well. A couple of things we are seeing though, Europe with their additional lockdowns recently, looks like they are going to enter a double dip recession. We're not predicting one here in the United States, but in Europe, we are expecting a much deeper drop this year. Growth could bounce back a little bit stronger next year as vaccines get distributed, but it's going to be a while before we see that. In the US, the drop could have been a lot worse. We're thinking about 3.5% is likely this year in terms of decline. And we're expecting almost a full recovery in terms of GDP by the end of the year, looking for growth to average about 3.3%. Japan, as you can see, that region expected to be the slowest next year. Go to the next slide. So the good news, we are seeing all the purchasing manager indexes, survey data around manufacturing services have moved back firmly into expansion territory. Anything above 50 on this index suggests that these businesses are growing again. And we're kind of back, almost back to pre-pandemic levels, but not quite. The bad news is we've been fading now for about 3 months. We peaked back in kind of July and August in some of these measures, and we're starting to see them accelerate to the downside. This morning, we got some disappointing data around retail sales for November. They were down over 1.1% in the month of November, and got a weaker data on service business as well. So this is certainly directly related to the lockdown, resurgence of the COVID vaccine. So we have recently cut back our forecast for growth as we move into the first quarter of next year. You'll see how that plays out into our forecast. Next slide. So our leading indicators, these are 10 indicators that tend to forecast economic growth 6 months ahead. This comes from the Conference Board. The good news here is these measures are still seeing growth. A lot of that's coming from a narrowing of interest rate spreads, the fact that stock prices are at record high levels. We saw households on net increase their household wealth by almost 5 trillion in the third quarter as home prices and stock prices surged. Financial conditions have loosened tremendously in the third quarter, and that's helping some folks that haven't lost their jobs are been able to work from home. They're actually feeling fairly flush right now, and if you add in the government support, there's certainly a big divergence in terms of winners and losers here on net. The economy is still expected to grow, though growth is slowing. Go to the next slide. So just to give you a sense of how this downturn in March and April really stacks up to all the recessions in the post-war period, it was the worst downturn really since the Great Recession in a month and a half, or since the Great Depression in a month and a half. The good news is we've made back a little bit more than 2/3 of that decline already, based on the growth we had since May. So that's good news. Things could be a lot worse. We're a little bit better right now. We're trending down about 2.5% on GDP from a year ago. So we're still, digging ourselves out of the hole, but it's not quite as bad as the peak of the Great Recession now. And we're certainly on that sort of growth expansion trajectory as we go into 2021. Go to the next slide. What's really been odd about this, and it's really, this downturn was really, going at warp speed compared to what you normally see in a recession. So a lot of our models, our macroeconomic models that are built on history, haven't been of much value here in terms of forecasting the economy. Usually these recessions play out over longer periods of time. The average recession lasts at least 2 quarters. The last one we had lasted a year and a half. This one lasted a month and a half. And we had all this government support on top of it. So we've seen some really strange movements. I'm sure you're aware of them if you're reading the newspapers, but things you wouldn't necessarily see. Usually in a downturn, people lose their jobs, their income drops, and we see secondary impacts as people pull back on their consumer spending, businesses pull back on their investment. This time around, we didn't see those secondary effects. So we had that big lockdown shock in March and April, and service businesses dropped like we've never seen before. So restaurants, bars, leisure and hospitality, airlines were hit the hardest. Some business services as well. But that's very unusual. Usually service businesses are pretty stable. Even in recessions, you can see what happened during the Great Recession. There was just barely declines in services spending, but we saw big declines in goods spending and durable goods spending in particular. This time around, it was just the opposite. We saw actually big increases in durable spending as people were at home. They were looking at, fixing up their houses. They're taking advantage of low interest rates to buy cars, in some cases buying new homes. In the suburbs or other states, but they scaled back tremendously on the services side. So services businesses are still the weak spot. Small businesses in particular are our biggest concern. We're also quite concerned as we look into 2021 about commercial real estate and where that may play out going forward. We already are seeing a lot of big companies looking to offload space as their leases expire, and we do expect big declines in commercial real estate values in both retail and office sides of the commercial real estate business. So we still got some issues to work through as we go into 2021, but like I said, things could have been a lot worse if we hadn't gotten that fiscal stimulus. So John Maynard Keynes, the famous economist that economists followed in the Great Depression is alive and well today, and that's where most economists think we need to continue to support the economy going forward. If you go to the next slide, the business investment side, we have seen some weakening of business investment in general in this downturn so far, but it's not been as severe as we saw during the Great Recession. So, where we're seeing again, the most weakness here is in non-residential structures. That's commercial real estate. construction and investment, but we're still seeing equipment spending bounce back now a little bit, and intellectual property is still quite solid. So while we do expect business investment to be fairly weak as we go into 2021, we're just not seeing businesses pull back to the extent you normally see in a deep recession like we've just seen. So that's good news, and there's some potential here for faster growth as we move into 2021. One reason why businesses have been able to maintain their spending is they were able to access the credit markets very, very quickly because of the Fed's policy response. They set up a number of credit facilities that stabilized financial markets. Stocks took off. And we know even companies that are having trouble maintaining their earnings and revenues, they've been able to access the credit markets to the tune of about $1.4 trillion in borrowing since this pandemic began. So they're able to access credit, so they're able to continue to survive, and we haven't seen big insolvencies or bankruptcies coming out of this yet. Next slide. So, the unemployment rate is the most concerning here. We got up to, like I said, almost Great Depression levels of unemployment early in this pandemic. The U.S. got up to 14.6% unemployment in April, much higher than what we got during the Great Recession, where we peaked at about 10%. The good news is we come back down quite a bit now, and we're below 7% now on the U.S. unemployment rate. We do think things could move up a little bit, and we're expecting in the first quarter of 2021, the U.S. unemployment rate could move above 7% once again, but then start to come down. So we're not expecting a big jump in unemployment like we saw in March and April, but there is some upside risk here on unemployment as we go into 2021, especially if we don't get another relief bill. Go to the next slide. Now, how bad you feel in this pandemic really depends on where you live and what industry you're in. Obviously, if you own a bar or restaurant, you're right in the crosshairs of this pandemic. But it also depends on what state you're in. And some states are obviously more exposed to leisure and hospitality and tourism. They've also been more quick to lock down their economies when COVID cases spiked. In California, unfortunately, is one of those states where we've seen the state be pretty conservative in terms of locking down, fairly early to do that, especially in Northern California and the Bay Area. But we're seeing that again as we go into November and December. So the bad news here is that even with a vibrant technology sector where Silicon Valley seems to be, IPOs are back in vogue, and we're seeing Zoom and all these other technology companies doing quite well in terms of their earnings growth. We're not seeing that create a lot of jobs here in the state. So California's unemployment rate as of October, the latest data we have, was still at 9.3%, the fourth highest in the country. The only ones higher was Hawaii, Nevada, which obviously have bigger impacts from tourism. And New York was slightly above California here. But there's other states that are way, way down the list. If you're in Oklahoma or other states, you're at very, very low levels of unemployment today. So you're really seeing that big divergence in terms of impacts. We're going to be putting out our California report later this week. We're updating the forecasts as we speak. And we do expect California's unemployment rate to remain well above the national average as we go into 2021. We do think we'll return to growth again in California. We're looking for 1.5% employment growth next year. But the unemployment rate will probably still remain above 8% on average next year. So again, it's going to be a work in progress, and we think it's going to take multiple years to get California's unemployment rate back down to the historical lows we saw before the pandemic. Go to the next slide. Again, just to give you a sense of where we are in terms of the recovery, we obviously haven't gotten fully bounced back. We did have that V-shaped recovery off the bottom. We're still down about 9.8 million jobs from our February peak in terms of employment. nationally, and that's still above the amount of jobs that were lost during the Great Recession. So again, we're plateauing now. We think in December we'll probably see job losses on net into this December payroll report. I wouldn't be surprised to see the unemployment rate rising nationally, at least for a month or two here as we work through these last months of the pandemic, hopefully. But again, we're kind of on again, this growth impulse we had in the third quarter is basically done for, at least near term. Go to the next slide. You can see really the uneven nature of this. You know, some economists talk about a K-shaped recovery where we've seen, you know, if you're in the leisure and hospitality sector, low wage jobs, if you're an immigrant, minority, or a woman, you've been hit harder in this pandemic than maybe others in other sectors like construction and manufacturing that actually has held up relatively well compared to past downturns. So if you're in government, leisure and hospitality, professional and business services, you've really borne the brunt of the job loss. And that's true all the way through November. About 72% of the job loss is coming from just 4 sectors here. But we're seeing things like financial services, construction, and to some extent manufacturing holding up fairly well. If you go to the next slide. Again, this gets back to my point I was making earlier about why things weren't worse and why we got that V-shaped recovery in the third quarter as the economy reopened. It's just really the unprecedented windfall we got from the government. You know, over $3 trillion, that's still a lot of money. Like I said, about 14% of our gross domestic product. So, you know, usually when people lose their jobs and unemployment rates go to almost 20%, you would see big income declines, big cutbacks in consumer spending. We didn't see that this time around because of the rapid nature of the government support. So current transfers to persons, individuals, skyrocketed, you know, more than double, almost triple what we saw during the Great Recession period, for example. If you go to the next slide, you can see how that plays out on a per capita basis. You know, you can see the gray bars on these charts are basically past recessions. And you can see usually you don't get much of a increase in per capita incomes, if any. This time around, we got a 15% increase in personal income per capita per person. That's how much money was thrown into this economy. Now that's coming off, right? We're seeing that surge of income coming down, but we're still about 5% above where we were before the pandemic started. So what that means is that some consumers have been able to build up their savings, pay down their debts, and maybe even refinance their mortgages to help them survive this downturn. So if you go to the next slide, you'll see that savings rate still at unprecedented levels. It's come down from record high levels, but again, the idea here being, you know, consumers and households have actually fared pretty well here compared to past downturns, and that certainly gives consumers the ability here as the pandemic eases to go back to the stores and spend again. So there is a chance here that the recovery could be somewhat stronger as we get the influence of the pandemic wanes. But there's a lot of uncertainties right now in terms of how much support we're going to get from the government, and that really leads to a pretty uncertain economic outlook. We know growth is going to continue next year. We just don't know, you know, with a lot of confidence how strong that growth is going to be. If you go to the next slide. You know, retail sales, this number came out before the new numbers today, but we're still up about 4.1% in nominal retail sales from a year ago. So we've really seen that full recovery in retail sales. Now the mix of sales have changed a lot. If you go to the next slide, you'll see what that looks like. So people have really changed their spending behavior and spending habits. So yeah, they're still going out there and spending. A lot of that's being done online. You know, non-store retailers are up 30% year over year. Building materials have been strong. Sporting goods have been strong. People have been buying cars and motorhomes. We do a lot of RV lending at Bank of the West, and we've seen record demand for RV loans, something you don't normally see. It's usually considered a luxury good, not something you see selling strongly in a recession. Grocery stores have done well as well. We're still seeing declines in restaurants and apparel stores. A lot of small businesses still, really continuing to struggle here to grow their sales. Go to the next slide. And these numbers will probably start to look worse again. So part of the reason why we're fairly confident the consumer is going to continue to spend, certainly as we move into the second quarter and beyond next year, is the fact that incomes continue to run ahead of spending. So consumers have really scaled back. We've built up those savings. If stock prices remain near current levels, we've got a pretty strong wealth effect playing out here. So that's good news, and that's going to probably keep the consumer spending at a pretty healthy clip as we go into 2021 and even into 2022 and beyond. Next slide. But I did want to share with you, because this pandemic has unfolded so quickly, we're tracking a number of indicators that on a daily basis to try to keep an eye on what's going on with the consumer, how the shutdowns are impacting consumer demand. And on those sort of metrics, obviously things are looking quite a bit more downbeat. Back during the summer months, restaurant reservations were down 25, 30% on average. They're back down about 65, 70%, somewhere in that range, depending on where you are. So definitely we've seen, people moving around has dropped about 15% in November compared to October. So we're definitely seeing consumer slowing down here, even before a lot of the lockdown and shutdowns orders were rolled out from state and local governments. Next slide. So again, the one area of the economy where we think we've got a lot of issues that we're still going to have to deal with is on the small business side. And probably a lot of the folks on this Zoom meeting are small business owners or know people who are small business owners. And, this is really an unprecedented shock for all of you. The number of small businesses that are open is still down almost 30% through the end of November. So basically, we've never gotten back to normal really since the shutdowns that started in March and April. So small businesses were the ones that really continue to suffer. And it wasn't just those that haven't been able to reopen, but if you look at the next slide, you'll see the latest data on small business revenues, which overall are still tracking down about 32% from a year ago. So revenues are certainly continuing to be impacted and buffeted. And if you're in the leisure and hospitality sector, you're seeing revenues down about 65, 70%. So it really does depend on what industry you're in, but small business in general are just getting shellacked here. And things have gotten worse, obviously, in the last few weeks. Go to the next slide. And, I wouldn't discount the impacts of folks if they lose their unemployment benefits. Like I said, about 13 million could lose benefits at the end of the year if we don't get an extension of those pandemic unemployment benefits, including folks like Zoom drivers and things that have been getting unemployment benefits. We know there's about 9 million renters out there that aren't current on their rental payments. And you can see that about 45% or so of renters say they're either likely or somewhat likely to be evicted over the next 2 months. So that's still a very real threat for the housing market and the economy in general. If you go to the next slide. So kind of putting this all together then, it's really going to be a tug of war here between the pandemic impacts early in the year and any sort of stimulus we can get from the federal government, as well as sort of a reopening recovery we're likely to see in the second half of the year. So we're a little bit below consensus for the fourth quarter. We're expecting 4% growth. So we haven't had to really scale back those forecasts at all. And we're looking like we're somewhere going to be in that range as we close out the year. But that's a big step down from the 33% annualized growth we had in the third quarter. So it's growth, we'll take it. It's actually better than what we can do on a sustained basis longer term. But I think as we go into the first quarter here, growth is likely to be closer to 1%. Some estimates out there is as much as a negative 1%. It really depends on how much this coronavirus surges and how bad the shutdowns get, and if we do get any unemployment benefit relief. If we don't get that, then I think our first quarter forecast is probably a little too optimistic. But I think we're obviously going to get close to 3% growth or higher in the second half of the year. I think there's some upside to our forecast as we look into the second half of the year. We're being kind of conservative on that front. I think we will get back to pre-pandemic levels of GDP by the end of next year, but that doesn't mean we're back to potential growth or where we should be in terms of full employment. We still think it's going to be 2 or 3 years before we get back to that level of GDP. If we go to the next slide. What does this mean for the Fed and interest rates? We've got an FOMC meeting happening right now. We should be getting some results from that about 11:15 a.m. this morning, our time. But we don't expect big moves. The Fed has already done a lot of the stimulus that they can do. They've dropped interest rates and the Fed funds rate to the lower bound to 0. They're expecting to keep them at 0 at least through 2023, and we think they might not raise rates until 2025, given our inflation forecasts. So what that means in terms of interest rates is, if you're enjoying these historically low mortgage rates and low interest rates to borrow for your business, we do think those low interest rates are going to continue as we go into 2021. So that could be a positive for businesses if they're able to access the credit markets. So a very flat yield curve going forward. We are seeing a little bit of steepening. The 10 years moved up from around 75 basis points up to just over 90 basis points on the 10-year. But we're still well below 1%, and I think we're going to stay below 1% next year. The reason being, I think the Fed will intervene if we do see a spike in inflation or long-term interest rates. The Fed will intervene by buying more long-term treasury bonds. They've already talked about that. We may even get some announcement from the Fed around what their expectations are for further asset purchases going forward. So this is going to be very important because one of the things, if we do get a lot of federal spending from Washington, that means we're going to have to go out into the market and borrow that. Everything else being equal, that would tend to raise interest rates as bondholders demand higher returns to absorb that debt. But with the Fed being a major buyer of that debt, that might not work. That might not happen. So we really got the Fed monetizing the borrowing here, which really gives the federal government a lot of flexibility to spend more. And so I'm really hopeful that we'll get more than just a COVID relief package, that sometime next year we could also see some additional spending around an infrastructure bill. I think is very important, maybe education, healthcare as well, to help really goose and jumpstart our economic recovery. And we've actually been thinking quite a bit about that and what the economic impacts of that could be, and I'll talk about that in a minute. If you go to the next slide. You can see the Fed's supports, not just from dropping interest rates, but their asset purchases, their credit facilities that they've set up, has really allowed the balance sheet to double from where it was before the pandemic began. Money supply growth is exploding. I don't know if you remember back in the Volcker days, when the Fed was being run by Paul Volcker in the late 70s, early 80s. This was a measure that economists, in markets looked at on a weekly basis. What this means is they're just really flooding the zone with money and liquidity. That's really allowing a lot of businesses to remain solvent, allowing a lot of folks to access credit. But on the downside, it may be fueling some asset bubbles and financial bubbles, and I'll talk about that in a minute. Let's go to the next slide. So there are side effects to this monetary medicine that are hard to avoid, and those could actually come back to haunt us down the road. The bond market inflation expectations have been moving up a little bit. These break-evens are what the market's forecast is for inflation over the 2-year, 5-year, and 10-year horizon. All those forecasts are below the Fed's target of 2% inflation. So the bond market isn't really forecasting any return to a stagflation sort of environment we had in the 70s. We're still looking at a pretty low inflationary environment. We expect the CPI inflation rate next year to be maybe just a little bit over 1.5% on average, though we may move up a little bit over 2 for a brief period. We think it's going to be a pretty slow inflationary environment going forward. So not really expecting a lot of inflation from these monetary moves. If you go to the next slide. So this is kind of our outlook. Again, the Fed basically next year, no rate increases from the Fed. We expect a little bit of uptick or steepening of the yield curve as we move in the end of 2021, but again, below 1%. So we're looking at a very flat yield curve, at least over the next 4 quarters or so, which means it'd still be a good environment to borrow, to refinance your mortgage, to buy a house. You're still going to see pretty attractive interest rates. Next slide. If you're a saver, though, it's not very good news because you're still not going to make any money on your money market or savings accounts. This is my concern, is that we may be starting to see evidence of a bubble forming in financial markets. I'm a little concerned about the equity market valuations here. We know they're extremely pricey at the moment, almost on any sort of metric you look at. Now, the bulls will tell you it's because rates are at historically low levels, and there's some truth to that. But if you look at kind of a cyclically adjusted PE ratio in the S&P 500, for example, over the, based on earnings over the past 10 years, this is a measure that Robert Shiller likes to use. He's a Yale economist, done a lot of research around financial panics, bubbles, and crashes. I did some research around this as well back in my grad school days. And what we're seeing right now is stock valuations that don't make a whole lot of sense given economic fundamentals or earning fundamentals. So the valuations have gotten extremely expensive here with record high stock prices. There's only 2 times, and really since the 1800s, where the stock market has been more expensive. That was right before the Great Depression in the 1929 stock market crash and the 2000 dot-com bubble. That burst in 2000, we saw big declines in equities there as well. So we're seeing some evidence of that already. The IPO activity we're seeing with some of these new IPOs like Airbnb have been really frothy. If Alan Greenspan was here, he'd probably say irrational exuberance is probably alive and well again. So all we know is that historically these sorts of events don't usually end well for stock investors. The small investors tend to jump in following these sort of trends at the wrong time. So that's something that could be a downside risk as we move in. It's hard to say when that could happen or what the trigger would be. Right now we're seeing a lot of confidence and optimism around the vaccine that's really driving stocks to these nosebleed levels. Go to the next slide. Did want to talk a little bit about the election outcomes and what that could mean for additional government stimulus bills or spending plans, and what that could mean to the overall U.S. economic outlook. So a couple of things I'd say is, it's really going to depend on who controls Congress, whether, Biden administration is going to be able to get their full spending package plans through. But I did want to share with you a little bit of what we know or could know in terms of, if Biden was able to get everything he's promised on the campaign trail through this Congress, which I don't think is likely to happen. We'll probably get something in between, but he's really planning big spending packages over the next 4 years. His biggest ideas around infrastructure, roads, bridges, electrical grids, water systems, electric vehicles, investment, R&D. That comes to about 2.4 trillion additional spending over the next 4 years if he gets what he wants through. We're also seeing significant increases in spending over $600 billion in things like education and healthcare. If you look out over 10 years, the numbers are even greater, almost 7 trillion additional spending from this Democratic administration, if all is said and done. Go to the next slide. In terms of percentages, about 59% of that added spending over the next 4 years is likely to be on those infrastructure plans, about 15% apiece for education and healthcare. If you go to the next slide. On the tax side, though, he does want to raise taxes on corporations. The idea was to raise corporate taxes from 21% to 28%. I don't think that's likely unless the Democrats can win the 2 runoff races in the Senate and basically control the Senate. But if they were able to do that, they might be able to raise another 1.4 trillion in tax revenue, about 800 billion of that over the next 4 years coming from the corporate tax increase. The others increases would be from taxing higher net worth households, higher income households to the tune, if you're making over $400,000 a year, for example, he's expecting to hit those households with higher personal income taxes as well as higher payroll taxes. That expected to bring in another 600 billion over 4 years if they were able to pass that. So I guess the point I'd like to make, if you go to the next slide, well, in terms of tax revenue percentages, then about 57% expected to come from companies. So part of the reason why maybe the stock market is doing so well here is that the stock market has kind of priced out the expectation that corporate taxes are going to go up strongly here as we go into 2021. And that's because that was going to be a big part of the Biden administration's platform in terms of tax increases. If you go to the next slide, I did want to emphasize here just how uncertain the outlook is. And it's really going to be driven not only by the pandemic and what happens there, and how quickly we can get back to herd immunity, but also the size of the spending packages that we're likely to see and the COVID relief bills we're likely to see. So running some of these numbers, when you're talking trillions and trillions of dollars of additional spending over a short period of time, you can have huge deltas, huge changes in your GDP forecasts. So you can see some of the biggest, running through our model, some of the biggest growth paths are if they were able to get through the full spending packages. Now we know from our Economics 101, more government spending tends to mean higher growth. You get the direct impacts from that government spending, but also multiplier impacts from that. So you can see that a Democratic sweep of both the Congress and the presidency expected to see, growth rates could be as high as 8%, and that's sort of a scenario. You'll see my baseline forecast in the blue. I haven't yet factored in, any real substantial infrastructure spending bills or anything else yet until we get more clarity on what could get through Congress next year. But I don't think that's going to impact much 2001. I think it's more of a 2022, 2023 issue. But there is some upside here to our forecast as we move out into 2022 and 2023, not only because we're bouncing back from these big declines in growth, but also the potential here that we get additional spending bills through Congress in 2021. So, but there's, again, a huge variation here in terms of how rapid the recovery could be. The US potential growth over the next 10 years is only expected to be about 1.6%. So all of these forecasts are somewhat above the US potential longer term. So it's a good outcome. Next slide. But that isn't, there's side effects, not only with the monetary medicine, we might get side effects from a financial bubble, but on the spending side, even with these surging budget deficits, we could get side effects in terms of higher inflation and weaker dollar from that. We do think the Biden plan, if it was fully implemented, would increase budget deficits even on a dynamic basis with stronger growth, about $2 trillion more in budget deficit from where they would be otherwise. So that again could lead to somewhat higher interest rates and somewhat weaker dollar than what we would have under a baseline scenario. If you go to the next slide. Our debt levels are already extremely high here in the United States. We're already our federal debt as a share of GDP right now because of the pandemic is already at or exceeding World War II levels of debt. And the forecast is that we're just going to go up from here, and it could even double over the next 30 years. So again, this doesn't even consider additional stimulus that we might get in terms of spending. So these numbers could even get worse than this. But so that's a concern, and we probably will need to raise taxes at some point down the road. If you go to the next slide. What does that mean for the local? Very quickly, just, and we'll open up for questions in a moment, but did want to share with you a little bit of what this means for the region, California, and for the Stockton economy, as well as California. Like I mentioned earlier, California's economy has gotten hit harder because the shutdowns have been more severe and more long-term. It's also the mix of industries we have here in tourism and leisure and hospitality. So you add all that together, the wildfires certainly didn't help in Northern California either. And so you're definitely seeing, California and Stockton both underperforming the national economy on average in terms of, job creation. Job loss has been more severe here and has lasted longer. Stockton's doing a little bit better than the state as a whole, but we're still down about 7.3%, about double what we are seeing in terms of the drop in GDP. If you go to the next slide, where are those jobs being lost? Well, in the Stockton metro area, it's really coming from three sectors: government, leisure and hospitality, and trade, retail trade, and other services. Those are the ones that we're really seeing the job loss, and it's very the distribution is very wide, and it's very similar to what we're seeing in patterns we're seeing nationally as well as at the state level in terms of the job loss. If you go to the next slide, in terms of percentage declines, you can see, you have to go back one. Leisure and hospitality down 24% in terms of employment, so definitely seeing devastation there. Other services, government down 13%. Other sectors that are doing fairly well, trades actually made a pretty good improvement here in terms of percentage declines, but manufacturing is holding, construction certainly are areas that we think will outperform going forward. Logistics is another area that's done quite well. So part of the reason why trade transportation is doing so well is because of logistics and warehousing. That's actually, the Amazon effect is playing out there. And that's been helpful for the Stockton area in order to, not seeing worse declines. Also, ag has been pretty good. Egg manufacturers are seeing some labor shortages. COVID has been rampant among farm workers, but demand has been strong, pricing has been good, and the mix of products that we see grown in San Joaquin Valley are actually doing quite well. So that's been also a stabilizing influence. Go to the next slide. So in terms of unemployment, we're still at 10.3% as of October in Stockton unemployment rate. You can see the US being much lower at 6.9. Our forecast going forward here is we do think Stockton could grow employment at around 1% in the coming year. Unemployment rates are going to come down, but probably less than a percentage point. So we think somewhere around 9.5 range for the Stockton unemployment rate average next year. So there could be, by the end of next year, it could be somewhat below that. But again, we're still looking at almost double-digit unemployment rates for another year here. So the dislocation for some folks is going to continue to be there. Their need for unemployment benefits, food supports are certainly going to need to be still in place in full in 2021. If you go to the next slide. Again, and this is the weirdness of this expansion in recession, is just the income effect has not been what you normally see. Actually, total personal income growth is accelerating in the region. It's up 18% year over year in the county. Again, that's really related to these government supports, the additional unemployment benefits. So that gives us some hope here with the better savings rates, lower debt levels for many households, that we could see a stronger than average recovery coming out of the COVID pandemic. Go to the next slide. On the housing front, housing has been relatively strong. We're seeing a good response from building and building activity. Permits are up 44% year over year. A lot of that's come from multifamily, but now we're seeing a reacceleration of small single family homes as well. If you go on the next slide. Really what's driving, the construction market, the residential construction market right now is just the lack of existing homes. Existing home inventory in San Joaquin County reached an all-time low in October of 1.5 months of inventory. So this is already leading to bigger increases in home prices, median home prices, according to the California Association of Realtors. in San Joaquin County is up over 10% year over year through October. And we're in many parts of California now, we're seeing double-digit gains in home prices from a year ago. Go to the next slide. This is a different price index than what the Realtors reports. This is the all transaction home price index from the Federal Housing Finance Agency, still showing in the mid 4 to 5% range in terms of home price growth year over year. So any way you slice it, home values are going up faster than people's incomes. Low mortgage rates certainly playing a role in that. We're also seeing strong demand from millennial households. Those in the 25 to 30 year range are actually starting to look to buy housing already. And a lot of them are moving out of the center cities and urban areas and moving to the suburbs and looking for bigger houses, more space, something they can raise a family in. So we think this is going to be a very important support for housing demand over the next 3 years. And we're already seeing the impacts of that. Let's go to the next slide. So that's the end of my prepared comments. I think we have some time here for questions. But I thank you for your attention. And I don't know if we're going to have a moderator ask the questions or, but I'll turn it back over to
As a
you.
reminder to our audience, please utilize the Q&A function on the bottom of your screen to submit questions to the speakers and panelists if time permits. For individuals who are tuning in from a mobile device, please email your questions to info@cahcc.com. And Dr. Anderson, here is the first question from the audience. Why has the stock market remained so robust while the actual state of the economy seems to be much worse? Will this continue?
So that's a good question. I think I touched on it a little bit in my comments. I do think there's a fundamental disconnect between the stock market and the economy today. I don't think we can explain it with economic fundamentals. I think there are some drivers of this that we can point to. One is just the unprecedented amount of monetary support from the Federal Reserve. The fact that the money supply is growing at almost a 60% annual rate. That money has to go somewhere. If it's not going into the real economy in terms of investment, it's likely going into financial asset prices. And we're seeing that not just in the stock market, but we're seeing money flowing into corporate bonds. We're seeing money flowing into the housing market, residential real estate. And so that's what's happening. My concern is that sometimes this doesn't end well. The Fed may have overdone it in terms of the stimulus early in the pandemic when it looked like we were facing another Great Depression. The problem is now, how do you remove that liquidity without creating a big drop in the stock market? So I do think the risks are high. The Fed itself put out a financial stability report just a couple weeks ago, which really said the risks to financial stability have actually gone up since May, not down. And really point to the fact that, equity valuations have really disconnected. And actually, I look back, I didn't show this chart in my presentation, but we've looked at corporate earnings that not the companies release, but what the government reports through the government GDP statistics and compared that to the equity market value. And what we've seen is a real disconnect there, similar to what we saw during the dot-com bubble. Period. So I think there are some pretty good parallels now between the dot-com bubble and what we're seeing today. I don't think we're kind of back where we were in the dot-com bubble in 1998. And we know that continued for another couple of years. So I'm not saying the stock market's going to correct any day now. We could see this overvaluation of the market for some time. I just know that eventually we do see that correction and a reversion to a mean happen. So I think from an investor's standpoint, you just got to be aware that there's a lot of risk right now in pretty almost any asset you're buying, including corporate bonds. And so be very diversified, both here in the U.S. as well as internationally, would be helpful to try to ride out the storm if we do see one.
And from the local government standpoint, what kind of stimulus design do you think would have the highest multiplier effect to the local economy?
It's a very good question. So, one thing I learned, I used to work for the International Monetary Fund in Washington. I spent some time with the government as well. And so spent a lot of time looking at these issues. And so it's not just how much you spend that really matters, but it's what you spend it on. And one thing that came out very clearly in our research back then, I think is very true today, is that, investing in productive things like education, healthcare, infrastructure pay huge dividends down the road. So it seems expensive up front, but right now is the time to do it where interest rates are low. The appetite for investors for debt is still quite high. Now's not a bad time to launch something like that, because then you can have multiple years, decades of economic growth as your investments pay off. So I'd like to see that. I think there's definitely a need for that. We've been neglecting our infrastructure for decades. Engineers will tell you we've got a D- or C+ on our infrastructure in this country. We definitely could see some pretty good, easy productivity gains from things like that. Also, just from one thing a lot of households are seeing is just economic insecurity in terms of income, in terms of jobs. So anything you can do to reduce that uncertainty will be helpful for sustaining consumer spending. So, things like healthcare, very important. People have healthcare, they're going to be able to work more productively. They're not going to have to take time off for their ailments. So those things are very important, I think, as we look at what can we do to boost our growth rate longer term, get into a better position economically and financially.
Next question. What is your take on the dollar? Are we losing the dollar as the world currency?
So the dollar, as you know, has been weakening pretty substantially. It actually strengthened during the pandemic, about 10% against our major trading partners. But since then, it's weakened about 15% since those April peaks. So I do think we're likely to see the dollar continue to weaken. I'm not one of these proponents that think the dollar is going to collapse anytime soon. It is still very much the global reserve currency, even with these rising deficits and debt that we're projecting, but it is something that's going to be eroding over time. So we do expect that over the next 2 or 3 years, we're going to continue to see the dollar erode against our trading partners. Right now, like the Chinese yuan looks undervalued against the dollar, so that could strengthen, for example. I do think the dollar is probably going to continue to weaken here. And especially if we get higher inflation, if we get a higher inflation input, the dollar could accelerate to the downside. But right now we've just got 4% declines every year in terms of the dollar on a trade weighted basis.
Next question. What will the long-term effects be on the economy of the huge increase in national debt during the Trump administration?
Yeah, economists have been talking about our debt and deficit for a long, long time. We knew we were running up against a lot of demographic issues, the slowing of our population growth, the aging of our population. So we were already, given the fact that we had promised all these big social safety net programs like Social Security and Medicare, and we continue to see healthcare inflation running well ahead of overall inflation and economic growth. We knew we were running up against a brick wall just because of those factors, but now we're playing into that by actually, over the past 4 years, cutting taxes to the extent that we did. It really didn't make up for that. Back in 2017, when they were debating the tax cuts in the Trump administration, the argument that was being made was that we were going to make up for those lost tax revenue by additional growth and productivity growth and business investment and job creation. That never materialized. And now with the pandemic, we're ending the Trump administration at a lower level of employment than we started. So that we're actually, obviously dug ourselves a bigger hole here. The fact that we're still looking at, we had over a $3 trillion deficit last year. We're looking at something around $2 trillion in 2021. Those deficit projections could continue be multiple trillions of dollars going forward as long as the eye can see. So that is an issue, especially, there's countries that are in worse shape. Japan, for example, their debt to GDP is already over 250%. We're at 100 today here in the US. So I'm not saying, it's Armageddon next tomorrow, but I do think the longer we run deficits like this, the degrees of freedom that we have continue to narrow. Our ability to finance a world-class military, to finance education, healthcare becomes more and more limited. So that's my concern, I think, as we look at this. And I'd like to see, what economists like to see is when the economy is growing, you're running surpluses on your federal debt, and then that gives you the opportunity to run deficits when you're in a crisis like you are today. The problem is we haven't been saving for a rainy day. We've been running deficits even in the good times, and that's going to come back to bite us in the long run.
Next, Dr. Anderson, your comments on departures of Tesla, HPE, and Oracle to Texas and the impact on California economy.
Yeah, I think that's important news, and I think the policymakers in Sacramento need to take note of that. I think what we're seeing, especially as demand falters, we're seeing in the work from home movement has happened. People realize that they have a lot more freedom in where they do business and where they live than maybe before the pandemic hit. And so you've got a lot of companies now looking at things like taxes and quality of life, housing costs. And one of the things, I'm on the California advisory committee, and one thing we continually talk about is just the unprecedented levels of poor housing affordability, unprecedented levels of housing here in the state of California, and that's a big impediment to stronger growth here. In fact, one of the things you'll see in my economic outlook for California is we're actually predicting bigger net migration outflows over the next 2 or 3 years, partly because of this effect. And so we saw similar impacts after the last pandemic, but I think these are more entrenched. And certainly when you add in, the climate change issues, the wildfire issues, policymaking in California had the luxury of the last 3 years of really not really taking into consideration as much what's going on in other regional states around us. California no longer operates in a vacuum. There's other attractive areas to do business like Texas. So you are going to see more and more companies taking advantage of that. We've already seen that to some extent. A lot of companies, when they decide to expand into new businesses, they don't do it here in California. They do it in other states, mainly because, just California is so uncompetitive compared to some of these other markets.
Comments on move away from cash economy to credit and growth of fintech model.
Yeah, so we're all becoming more, the banking model is becoming more and more abstract. I don't remember even the last time I went into one of my bank branches. We do a lot of all of our banking online these days, and the younger generation is getting more used to and comfortable with that approach. We're certainly being influenced by what we see in these social media companies and other tech companies online. The fact that Amazon is able to deliver stuff in a day or two, has really increased people's expectations around how they do business in finance. So I think that's part of it. So I do think we're moving away from a cash economy. Most folks have credit cards. They don't do a lot of their spending with cash even. The real debate right now among macroeconomists and central banks is what is going to be the role of cryptocurrencies, Bitcoin and others. Will that replace national currencies, or will countries have to issue their own cryptocurrencies? So I don't think we've really settled on anything right now. I don't think Bitcoin itself or any other cryptocurrency at the moment is really a real alternative to the dollar. It's not really a great store of value. It's very volatile. It's a volatile, it's an asset, it's a financial asset, but not a currency yet. That doesn't mean they can't have one. I do think there's concerns around, fraud and, illegal activities that are financed through these sort of mediums. And it really would be hard from a monetary policy perspective to control some of that. So I think the central banks and the government itself will want to have some control, even if we go to this sort of new world. And so I wouldn't be surprised if some of the central banks start to experiment with national cryptocurrencies. And that's in the direction I think we might be headed in.
Now, you speak of freedom to work anywhere with telecommuting. What do you see the future of investment in broadband infrastructure looking like for smaller cities that do not have access to the rural grants being offered for broadband for infrastructure upgrades?
Yeah, I think it's a huge issue. The US has gotten behind a lot of other regions of the world in terms of broadband access and the cost of that access. So I do think there's things that need to be done, really at the federal level, to accelerate the process of getting broadband to more and more parts of the world. Now, the private sector is trying to do some of that. Elon Musk with his satellites are trying to, give people access to the internet anywhere you are on the globe. So there are some efforts going on like that, but I think there's a big role here for the federal government to get involved and to actually mandate some of these changes. We've had a lot of promises for the telecom companies that they're going to do these sort of upgrades, but then they never seem to happen to the extent that we really need to. And it's really exacerbating the economic performance we're seeing between the have and have-nots in various regions of the world. Part of the reason why the rural areas of America are underperforming the coastal areas is because of some of that access. So I do think it's a big issue. We do need to get a handle on that. I think there's some scope here for a national R&D program, actually, and even some pretty prominent macroeconomists from MIT and others that are kind of thinking about going back to a model we had post World War II, where we had these private-public partnerships that really, basically were the cradle for us, developing our technology industry, the semiconductor sector, the internet, and others. And we could go through another round of that innovation with a new round of public-private partnership.
Anderson? Dr. Anderson, this is the final question from the audience. We need to support our companies and businesses in California. What can we do to make California more competitive and to retain our workforce and companies?
Yeah, I mean, we love the economic environment we have here. The climate is great, but I do think we need to pay a little bit more attention to our cost of living. Housing's like a big issue there, and I also think from a business perspective, we have very high costs of electricity, water, land. So we on the regulatory side, there's ways we can make it a little bit less onerous for businesses, make it a little more friendly. Some tax incentives could be used as well, subsidies in other areas. I do think one area of where California can really outperform is around green energy initiatives, electric vehicles, solar panels, these new sectors that the new administration really wants to invest heavily in are natural industries that should find a home here in California. It would be devastating if California wasn't able to grow those industries and hold on to them. So that's one area of a bright spot, I think, as we look into the next 10, 15 years where California can really shine. We actually might have an equivalent of another Silicon Valley around that, those changes.
Dr. Anderson, thank you so much for your time And may you and your family have a very Merry Christmas and a Happy New Year. We appreciate your time. Thank you.
Thank you for
And
having me.
now,
everybody.
ladies and gentlemen, a message from Energy Upgrade, California.
This little light of mine, I'm gonna let it shine, let it shine, let it shine, let it shine. This little light of mine, I'm gonna let it shine, I'm gonna let it shine. This little light of mine, this little light, I'm gonna let it shine, let it shine. This little light of mine, little light, I'm gonna let it shine, let it shine, let it shine, let it shine. Everywhere I go, everywhere, I'm gonna let it shine, gonna let it shine. Everywhere I go.
We have the power to harness California's abundant solar and wind energy, but it's not available all day long. Use less energy from 4 to 9 p.m. for a cleaner California.
Please welcome back to the webinar stage Lisa Vela, CEO of the San Joaquin County Hispanic Chamber of Commerce.
Thank you. Good morning, everyone, and thank you for joining our presentation today about time of use, which is a critical shift in how we use energy. One thing we learned in our efforts from last year's program was that for our community to fully understand the complexity of this shift, we need to reinforce the message multiple times over many months. Because of this, could be a significant change for many people and their utility rate. It's important to understand how adjustments at home can make a big difference. We found with our experience last year, it took a few times for the message to sink in, and relaying early and often was key to making sure no one gets surprised during the transition. As discussed in our regional briefings, the San Joaquin County Hispanic Chamber of Commerce is proud to partner with Energy Upgrade California to deliver more on the important subject of time of use, or TOU, from Pacific Gas and Electric. You're all probably wondering, what is time of use and why does it matter to me? Well, TOU refers to your utility rate plan, in which rates according to the time of day, season, weekday versus weekend. Businesses already use TOU rates, and residential consumers across the state are transitioning and will continue until 2022. It's important to understand that when we use electricity matters, not just how much electricity you use. By moving some of our energy use to certain times of the day, we can better align our usage to when cleaner energy is more abundant and help protect our state. Therefore, our call to action to you is this: power down or use less energy between the peak hours of 4 p.m. to 9 p.m. Spending more time at home
Spending more time at home can mean higher energy use and increased energy bills. To help combat this, Energy Upgrade California has compiled a number of digital resources to help you become a better energy manager and possibly even save money. We also encourage you to visit their website, energyupgradeca.org. That's energyupgradeca.org to learn more. And let's keep California golden. Next in our program, please welcome Jessica Chancellor from our partners at PG&E, representing pricing products, rates, and TOU transition.
Great. Thank you so much for having me this morning. You can go ahead and pull up my slides so I can have it for the presentation. Okay, perhaps the slides are not coming up. Would you like me to try to share the slides on my side? There we go. Go ahead and go to the next slide, please. So good morning, everyone. My name is Jessica Chancellor. As stated, I'm with PG&E, Pacific Gas and Electric Company, and I appreciate the opportunity to be here with you all today to touch on a few items. Most importantly, we want to talk about rate options, ensuring that customers are aware that they have communication preferences. We can assist customers with getting information to them in the language that they prefer, as well as ensuring contact information is up to date. Sharing with you some information in regards to assistance programs that are available to help our communities, and then give you a look at our residential time of use transition schedule that is currently underway right now. Next slide, please. Okay, so as rate options are available for electric customers, we understand that rates are not a one-size-fits-all approach. There are different needs for every household. Sizes of households are different as well. And for that reason, we do have a variety of rate plan options available. A lot of customers are not aware of that, though, unfortunately. And so it is our duty really to make sure that they are aware and that they are educated on the tools and resources that are available to help them understand what is, in fact, the best rate plan for their household. We do have a tiered rate plan, which means that the more you use, the more you pay. This is what the majority of our customers are on today. We will start to see that that is going to shift, though, to a primary rate plan being time of use. And with our time of use rate plans, that matters not just how much energy you use, but what time of day you're using your energy. It does put the control back in the customer's hands to allow them to shift and save on energy, whether it's being used during peak hours and moving those to off-peak and helping to lower their bills overall. And then we also have an electric vehicle rate plan for those customers who do have battery storage or have an electric vehicle at their home. Now, the message that we want to get out to customers today is not only that they have rate options, but to simply go online and run a personalized rate comparison to ensure that they are, in fact, on the best rate plan for their household. We have a tool that is available that allows the customer to see based on how they've been using their energy over the last 12 months. So including the time of day that they've been using it, as well as how much energy. What is the best cost rate plan for them? Now, if they can shift or conserve some of that energy, they could save even more money. And I think in times like this today, we need all the help that we can get in lowering our costs in anything that we do. So please refer customers to go online to run that personalized rate comparison. And if there is an online inaccessibility issue, that's okay as well. We can have our customers contact our contact centers and have them run the personalized rate comparison for them as well. Next slide. Okay. Now ensure that we're getting information to customers in the way that they want to receive it and that they're getting those important safety messages. We're asking that customers go online or contact us in our contact center to update their language preferences to how they want to get their bills and safety messages. We have numerous language options available to customers. Our contact centers are equipped with translation services for hundreds of other languages. And you can simply, as I said, go online, pge.com, and update that language preference to what's going to work best for your household. And then update the contact information as well as to where you would like to receive any kind of voice messages. Go ahead and go to the next slide. Okay. Now, assistance programs are something that are available to our customers. We have multiple programs. One of the programs focuses on income eligibility. That is where we have our CARE or FARA programs. CARE stands for California Alternative Rates for Energy, and then FARA is Family Electric Rate Assistance. Both of those programs provide an income discount, an income qualified discount on your electric bill. The CARE program does provide a discount as well on gas service. And then Family Electric Rate Assistance, FARA, is for those larger homes that have a larger income, provides a little bit of additional discount there, 18% off electricity. So you can simply go online at pge.com/care-FARA, or you can contact us in the contact center and we'll be happy to assist you with enrollment. Next slide. Okay, a few of our other programs available to customers is Energy Savings Assistance Program. This program is to assist customers with making the home more energy efficient. The great thing about this is that a customer does not have to own a home in order to receive assistance for this. If they are income qualified, whether they rent or own their home, they can get assistance in upgrading their home to be more energy efficient. Some of those things might be caulking, weather stripping, in some cases, insulation. There's many things that a customer could qualify in order to make their home more energy efficient and in turn, ultimately lower their bill. To qualify for that, you would simply go online. Again, you can also contact our contact center for assistance. And then we have our medical baseline program. Medical baseline provides more usage at a lower rate for our customers and in turn then lowering their bill. A customer that could qualify for this would be somebody within their household that requires additional assistance from either gas or electric service, so they might need more heating or more cooling, or they have a piece of equipment needed for a medical condition. A common one might be a sleep apnea machine, or possibly maybe someone has arthritis and they need to have additional heating to ensure it's not cold and impacting their health. So those are just some of the items that would qualify for a medical condition to get that medical baseline program. And you can go online again or contact our contact center for assistance with enrollment in that. Next slide. Okay, now we currently have underway right now a residential time of use transition. As I stated before, right now the majority of our customers are on a tiered rate plan. That means the more you use, the more you pay in terms of your electric costs. And we are in an initiative right now to not only help put control back into customers' hands by moving them to a time of use rate plan, but to really help our environment, to the sustainability of our electric grid, ensuring that we have ability to meet the demands of our customers during peak windows, as well as utilize the renewable resources when they're most plentiful. So if we can get customers to shift outside of that 4 p.m. to 9 p.m. window, when demand on the electric grid is at its highest, we can all benefit from that. One, customers can see lower costs. Two, that we'll be able to utilize renewable resources during that time. So right now we have our transition schedule, as I said, is underway. This month, we will begin sending notifications to the Sonoma-Mendocino County area and letting them know that in the month of April of this next year, they will be moving to a time of use rate plan. As you can see there, there are other counties and communities across our transition schedule that are broken up. It's something that's going across our entire territory. So we have this underway all the way through to really April of 2022 is when we'll be closing that out. Prior to a customer transitioning, they will receive at least 2 notifications advising them of that. And whether they are part of the transition or not, customers still have a choice in the rate plan option that they choose for their household. If they choose not to take action or select a rate plan, then they will be moved to a time of use rate plan if they are included in the transition. Next slide. Okay, so this takes me near the end of my presentation, what I wanted to share with you all today. If you leave here with anything that I've said, I would just encourage you to, one, go online, run that personalized rate comparison, ensure that you are in fact on the best rate plan for your household, encourage your family and friends to do the same thing. If they don't have access to online, simply call our contact center, allow us to do the work for you. But it's very easy. It takes the guesswork out of understanding what best rate plan would be suited for your household, considering how you've already been using your energy. And then again, if you can shift or conserve energy, it's a win-win situation for you. You'll be able to save more money. Number two, update your communication preferences. Make sure that we are communicating with you in the way that you want to receive communication. So making sure that you have the right language associated with your bill and that your contact information is up to date. This is really important with the public safety power shutdowns, because this is how we communicate with you any PSPS events that might be in the future. And then programs are available to assist our customers. Some don't believe that they qualify, and they'd be surprised that they do. So it doesn't hurt to check to see if there are any programs that you might qualify, referring to the ones that I discussed today. And you can go online to check those out as well. And then we have our residential time of use transition schedule. And based on the county and community, customers will be receiving notifications prior to, approximately 90 days prior to your scheduled transition. So just be on the lookout as we approach that timing for your county for the notification to come your way, or simply go online and check and change your rate plan at any time to, again, what best suits your household. Now I'll open it up for questions. I believe we might have a couple minutes.
Hi, Jessica. I believe that, well, this is going to give me an opportunity, first of all, to thank you for your very important and informative information for our participants. And this also gives me an opportunity to thank Dr. Scott Anderson and for his information as well. And a special thank you to Bank of the West for their partnership. This information is so key and so important for our members and for the community. So I think that this is also going to lead to what Scott was saying, how we can help here in California. And one thing is to go green and also to be able to save where we can, and businesses and also the community can benefit from this information. So I wanted to thank you very much for your help with it.
Yes, absolutely. Thank you for having me.
Thank you. I think we can go ahead and proceed to the next part of our program. But again, thank you so much, Dr. Anderson, and for your information, and to Bank of the West for their partnership and for his presentation. Very important. Thank you. We're ready to proceed.
During these challenging times, it is critical that we come together to overcome the obstacles we are all facing. We thank you all for tuning in. For any questions, please contact info@CAHCC. And for Jessica, the question that has come up is, COVID-19 has impacted our way of life and cash flows. Can you recommend a program that can assist a small business owner?
For small business owners, the same information applies really in terms of rate options. So I would recommend that a small business owner go online. This doesn't just apply to their household, but also to their business, and ensure that they are in fact on the best rate plan. In terms of income, we don't have any programs to assist with that piece of it, but ensuring you're on the best rate plan is definitely the place that I would start.
Thank you, Jessica. And now, next on our program, our political analysts will discuss the 2020 election outcomes and what they mean for businesses in California. To moderate the panel, please welcome to the virtual webinar stage Julian Canetti, President and CEO of the California Hispanic Chambers of Commerce.
Well, thank you, everybody, and welcome. And it's great to be with everybody. And thank you to the San Joaquin Hispanic Chamber of Commerce for their invitation for me to participate and lead this panel. You know, we're in unique times here with COVID. We have a new president coming, a new administration, and there will be changes, at least here in California, with a new senator being put in place, and that may open up other positions throughout, as well as the attorney general position. So, you know, I think this panel is going to focus on really what are those impacts that we see both in the, you know, post-election 2020, as well as with COVID here before us, how that impacts policy and legislation that will be forthcoming, and just give a good outlook of what you can expect, especially at the state level, but also, you know, our three panelists have a pretty good idea nationally as well. So they track that they've all been in national politics at some point in their lives. So with that, I'm going to introduce our panelists. Our first one, and I'll introduce the panelists first, and then we'll go right into things. But Jose Atilio Hernandez. Jose, you want to wave there so everybody knows who you are? And has worked for the past 20 years in developing and implementing policy solutions at the state, local, and federal levels. Currently, he is the founder and president of Idea California, a public relations and policy management firm, and is also founder of Idea Labs, a nonprofit policy think tank. Prior to Idea California, Jose served as director for external affairs and communications at ConnectEd. He also worked for 6 years in the California State Senate as Director of Policy and Development for the 20th Senate District out of LA. He actually began his public engagement and communications work with Latino Issues Forum, a statewide public policy and advocacy organization out of the Bay Area, and received his BA in sociology from the University of California at Berkeley. And Jose brings a great perspective, as I said, at all the levels, but also unique impacts on our communities here in California. Our second panelist will be Ron Wong. Ron Wong is president of Imprenta, where he's responsible for overall management and growth of the company. Through his leadership, Imprenta has grown to be one of the largest independent PR firms in California. He is a recognized political community leader with more than 30 years of professional experience. He successfully built one of the nation's most successful multicultural media advertising, political campaign, and public relations firms. He advises C-suite executives and prominent elected officials on communications, media marketing, and political strategies. He also served in the Clinton administration and senior staff to Governor Gray Davis and Speaker of the Assembly, Willie Brown. He's a graduate from University of California in Los Angeles, and UCLA Anderson School of Management. Ron, again, brings a unique perspective, especially at the state level, all the work he's done there, but as I said, at national level. But he has been key at advising, especially on political strategies for a number of organizations, as I said, and major corporations, corporate 500 firms as well, and various political campaigns. And our final panelist is Mike Madrid. He is a communications expert and nationally recognized expert on especially Latino voting trends. He has served as press secretary for the California Assembly Republican leader and as political director for the California Republican Party. In these roles, he played key roles in pioneering Latino outreach and communication strategies. In 2001, he was named as one of America's most influential Hispanics by Hispanic Business Magazine, and he's a regular commentator on Latino and political issues and political issues in general on statewide and national media. Since 2000, Mike has also developed an expertise in local governments in California. He served as Public Affairs Director for the League of California Cities. In 2011, he also helped develop Leadership California Institute, an organization dedicated to educating and training future California leaders. Mike is also the editor and publisher of California City News, a news site dedicated to the best politics, policy, and practices of local government in California. And Mike, again, like our other two panelists, brings a unique perspective on the entire political spectrum, both from national, state, and local politics. And I think all three of them have a pretty keen eye of what to expect post 2020 election and how COVID-19 is impacting us. So I want to start with Jose and just, his opening as to, well, where he sees California at, both state and nationally, especially in this post-election period. New administration coming in, as well as we still have COVID-19 on our heels here. So Jose?
Hi, thank you, Julian. Thank you, everyone. Again, a pleasure to be here. Pleasure to talk to the chamber and all the chamber members. No surprises in California in terms of overall kind of the positioning. We still have supermajority in the Senate and the Assembly. We have 8 new faces to the Senate, 9 new faces to the Assembly. One thing of note is the propositions. I think the propositions didn't go the way some people thought they would go. The voters actually turned down 2 pieces of legislation that the legislature pushed forward. That was AB 5 and also the bail reform. And they rejected another proposition that was put on by the legislature. So that signals something in terms of kind of the vote of the people versus what's coming out of the legislature. And we can talk about that a little later on. But really, I mean, as you saw in 2021, I mean, really devastating to small business and business, kind of some of the actions locally and statewide in terms of closures and the different messages coming out, the different mixed messages as well in terms of being able to plan for it. And one of the things that we weren't able to control, but we try to influence, is definitely kind of some of the safety net programs for business. I mean, in terms of the federal funding, some of the local funding. One stat that I saw today that we definitely have to work on, though, is that out of the PPP loans that went out, only 6% were utilized by Hispanic and Latino businesses. And so we kind of nailed down kind of what that means in terms of, was it tech assistant, was it language? I mean, really, what was it? But kind of an opportunity now in terms of new folks in the building, opportunity to increase kind of our political will to bring some of those safety net programs down. It's still going to be a COVID year in terms of while the vaccine is here, we don't see it kind of permeating all the different essential and non-essential work sites. We're going to see business slow down in the capital in terms of having access inside, but really it allows us sometimes to have even greater pressure in terms of kind of this new virtual world. And we can talk about that as well in terms of how to leverage our support. But one thing that will come down in terms of our economic recovery is honing in on the essential worker aspect as we slowly come back. We've done a great job in terms of the different sectors. I know that both in the Assembly and the Senate, it is one of the top kind of 4 or 5 issues that they're discussing, along with broadband. And we talked a little bit about that and just what that means for a lot of our companies that we've had to pivot, do things a little different. And so definitely in the broadband discussion. Housing is also one of the major issues coming out of the legislature that will be addressed. And there's this connection. I mean, we saw a lot of the moratoriums being put in terms of evictions. That's still on the table. But now there's a greater understanding what that means to landlords, what that means to property owners, that there is kind of an effect if people are not paying their rent, what kind of pressures that put on Latino, Black, and other underrepresented owners. And so that's something else that will come back. And then a great follow-up discussion. I know we were talking about energy, but I mean, that's one of the things that we always talk about, cost pressures on energy, wildfire. And so that will be also top of mind in terms of Sacramento. But the main question right now is kind of, the trickle-down effect in terms of some of these vacancies. We have Attorney General, we have the US Senate. if a certain Secretary of State is placed on the U.S. Senate, now we have a new Secretary of State. So that's some of the fun politics that I definitely want to talk about in terms of this changing of chairs that'll happen, and the opportunities for the California Hispanic Chamber to be at the table as those changes happen. But overall, we saw the Anderson forecasting. We're seeing a much better year this year. We're not $50 billion in the hole, probably about $25 billion. A lot of ramifications in terms of DC. We expect more stimulus dollars to come out. The question is when. We're hearing as soon as January 22nd, maybe. That's not possible, but we do expect it to come down quickly. And we do now have access directly to the White House in terms of our vice president. Typically that has been a underutilized role, but I think that California, we have an ability to lead on different things, and we're gonna definitely maximize the position of the vice president. But those are a couple of things. I do want to tee up a couple of conversations afterwards. But again, thank you for having me, and I look forward to the discussion.
Thanks, Jose. Next is Ron, and I really have to thank Ron and because he's actually on vacation and took a little bit of time. He's taking some time out of his vacation to join us here today. But Ron, from where you sit, and I do want to say that all three of these individuals are business owners. Don't be fooled, and they have employees. And I think their perspective, they're small business owners, also their perspective comes from some of the impacts also that they're going to be faced with, they realize, because of legislation and policies that may come down the road. So Ron, you've worked a lot of state, the propositions this year, a number of electeds, a number of corporate interests, et cetera. So where do you see post-election where we're going, what California is going to be faced with? And I know you served in a previous president's administration. Also, Jose kind of touched on where you see that relationship going to, since California has a key person there now as well. Ron?
Well, thank you, Julian, and it's really a pleasure to be with all of you back in California. I'm here in Hawaii, and I would wear a coat like my other two panelists, but this is dress up for Hawaii. So it's really great to be here on with my good friends Jose and Mike, and I really just want to start to engage them in a conversation because I really love to hear their perspectives, particularly Mike's, because I've been watching the Lincoln Project and what all they've been doing. But let's begin there at the federal level. I think what we want is, and everyone wants, is some sort of return to normalcy, right? Where we could have a normal president who, normal in the sense that at least doesn't buck the trend and shock us every day with something new and outrageous, but where policy could get done and people could reach across the aisle, because that stability helps businesses, right? And that helps corporations, and it helps everyone feel more comfortable. I think that in one sense would be some sort of return to normalcy that we're all craving. And, and the Biden folks are working just like they would any other administration to put their cabinet together. There'll be a lot of California people involved with that. Names are being kicked around, some of our own Californians, which would be really great if you own a small business, let's say in transportation. David Kim, who's our secretary here, his name is being mentioned for transportation secretary. We have an OMB director, Nira Tandy, who's originally from California. So I think it's that sense of stability that we're all craving and in some ways lusting for, right? But I do want to throw some provocative ideas out there, in that, because Trump is the way he is as the president, and now he hasn't conceded yet, but all things indicate he won't be occupying the White House in soon order, but you never know. But America has never had an opposition leader in the way that some other countries have. Europe, when you have countries with dictators, when they come out of office, there's always this fighting going on. So I think we need to brace ourselves for something like that. We didn't hear a peep from President Obama, generally speaking. We didn't hear a peep from George W. Bush or George Bush, HW, or President Clinton when they left office. I think that is going to be different. So in some respect, this return to normalcy that we're all craving, I think we need to question, and we need to see whether that holds true, right? What would it be like if every time the Democrats, for example, in the stimulus package that I think has been negotiated for the last 5-6 months, if not more. Hopefully it comes to a close soon, because that will have implications for business owners, right? It'll have implications for local government, and Mike can speak to that more, for state government. But it can get held up if there is an opposition leader, and depends how the senators go. If we don't win the Senate, I'm a Democrat. If we can't win in Georgia, you had 100 some odd congressional members say that they don't see Biden as the president yet. So these are things that we need to watch, because what business wants is stability. And I think, generally speaking, there's this, let's be honest, we live in a trickle-down economy. That's what the stimulus is about, right? But we've had really a COVID era economically where the haves got more and the have-nots got less, right? And Jose alluded to this on things like the PPE loan. Why did very, very small businesses, right? Because small business, under the definition, can be a huge business, could be a $50 million business, or it could be a mom and pop with literally people not making salary because it's your brother and sister and they're not going to sue you, right? But those restaurants are on the edge. Those mom and pop, whether they're nail salons or anything of that sort, are on the edge, and they did not get PPP loans. And one of the reasons why, and it's been documented, is that there's been a huge decline in minority banks that cater to the Latino community, banks that cater to African Americans, right? And there are unique issues in the banking industry that that need to be overcome. They don't have the relationships with the Bank of America. For example, I sit on the MALDEF board, Mexican American Legal Defense Fund. They did not get a PPE loan. They had to wait. They ultimately did on the second wave, but they were closed out because in that banking relationship, they were banking with B of A. All due respect, many of you may bank there, but it's the people who had the closest relationships that got that kind of service, right? And so when you don't have the minority banks, you don't have that infrastructure, they get less of the loan. So it remains to be seen, although I think it's critical that we do pass something quickly that will have direct impact, not only to the consumer and the owners, but to the businesses themselves. But we have to really look at, is that money getting to the smallest businesses possible? So that's something we need to demand, right? And hopefully, in the appointment process, we have people more, we have people more friendly to those ideas and attitudes. And it can't be understated how California is perceived. Because Julian mentioned I did work in DC. It's good that we have Kamala Harris there, because when you're in the East Coast, things tend to be East Coast centric. If we could get Neera Tandy at OMB, that would be a great thing, because everything runs through OMB, Office of Management and Budget. You can't understate how significant that position is. There's other great names being batted around from the Latino community, African American community, API community that we need to get behind and support. Jose alluded to the musical chairs happening here in California. All of those things will have an impact of who gets those slots moving forward. Javier Becerra going to HHS. We can't understate how huge that is. That's a huge, it's one of the largest government bureaucracies, right? And who his deputies are and the people that play in those roles. So I think in that way it's dynamic. I'm cautiously optimistic, but I do throw out that we could have an opposition leader never like we've had in the United States' history. So there are issues there that we need to be mindful of. But overall, I think the economy, it's gonna get a little bit worse before it gets better. They're saying in the UCLA economic forecast report, they're saying that it will get better third and fourth quarter evenly. But can you really hold on that much longer if you're a small business who's had to shutter, right? And we really need to be looking at what is in the stimulus package. They're going back and forth. The Senate is playing hardball with Pelosi. So any roles we could play in getting our voice in there. Now, there's one thing I want to close on, and that is the California proposition that we just saw. And I'd love to get Mike's perspective, because I know he works a lot with local government and Jose as well in the state. What we saw in California was very, very schizophrenic, right? And I always said that California is kind of like the United States in some sense, and you all are in the San Joaquin Valley and Central Valley. So New York and the West Coast, East Coast, West Coast. It's kind of like San Francisco, LA, with Central Valley being the middle, the heartland, right? So in San Francisco, kind of leading the way to like, let's just call it out, socialism, basically, where you had a DA there and who didn't enforce petty crimes, right? So if you own a liquor store or a small convenience store or even CVS, and people are walking out with candy and soda and they're not being prosecuted, that is for real, right? That happened in LA, right? We elected their district attorney. I live from LA, Gascon, who he's already said he's not going to be prosecuting certain crimes. That's not good for business. When you have homeless people, you drive. Jose and we occupy. We're in downtown in the same place. It's zombie land down there. So under this recovery, what's going to happen now in Central Valley? What happened was that, because I was working for the Democrats in the Congress, we lost congressional seats in Central Valley. We meaning that there's a moderate vote, a more conservative vote. And also on the initiatives, nobody wants to be taxed now. So anything that had to do with money got rejected. Uber did a great job, but they spent a lot of money to convince people, right? But the one thing I will say, and I want to close on, was Prop 16, the affirmative action, because I do think that minority businesses lost out without that getting passed. And it remains to be seen whether proponents will go for it again. And I know Latino and Asians generally opposed Prop 16, right? And, because they were focused so heavily on education, but really small business contracting opportunities, we would have had the chance to have a bigger voice, a bigger opportunities for minority businesses if that had passed. But it lost by a fair amount, and I think minority businesses did not come out as strong as they should have. So we see this kind of schizophrenia. We see the two cities, San Francisco and LA, going socialist in certain ways, but we see Central Valley more moderate, more conservative. So that's going to be interesting how that plays out. I'll turn my time over to Mike.
Thanks, Ron. Great perspective. So I'll go over to Mike, and Mike, I'm looking forward to, as people always do, your perspective on all this. And Mike is not a person that stays silent. He's always been very vocal on how he feels, both with Republicans and Democrats out there. So I appreciate him taking the time to join us today. Mike?
Sure. Thank you all for having me. It's good to be back with good friends. And Ron, Jose, it's good to see you both doing well after a long, tough election cycle. It's good to be recouping. I know as we get older, it gets harder every cycle, but here we are. And as we're trying to read the tea leaves on what happened, it's pretty clear to me that a number of very unique dynamics, I think, have changed both the national political climate, and we see them really evident here in California too. So let me talk about those just a little bit. As many of you know, about a year ago this Thursday, 8 of us created and established an organization called the Lincoln Project. It was current and former Republican political consultants who were very concerned about Donald Trump and what we defined as Trumpism. I'm going to talk about that a little bit because, as I think both Ron and Jose alluded to, while Donald Trump was successfully defeated, from my perspective, the dynamics which created the Trump presidency have not. In fact, I would suggest they're going to get much stronger, and I think they're going to be extraordinarily detrimental to business and business interests, and we'll get into that in just a moment. But before I go there, what I want to talk about is some of the schizophrenia that Ron alluded to, I think quite correctly. This was like the highest turnout election in the history of the country. When all of the votes are tallied, we will probably have 156 million voters. That's about 6 million more than we saw in the 2008 election cycle, which was the previous high. This election, candidly, as political observers and political professionals will note, was really not that close. It was not that close. There were some states which looked close, but even Georgia, Arizona, Wisconsin, as a practical matter, we're not that close of a contest. And what is frightening about what is happening in this country at this moment is we have a president who refuses to concede, which is scary enough, but more perhaps concerning and alarming, again, I would argue for the center right and for business interests specifically, is the growing cadre of people who are following the president and believing this nonsense despite absolutely zero evidence suggesting his claims are true. The reason why that is so dangerous is because the center right, which has historically been the base of support for small and large business interests, no longer is. And that's the message that I convey to my business clients, both here in the state and nationally, is to reposition and be prepared for the coming 2 decades. I think it will probably be at least a generational stretch before we work ourselves through that. And let me be very clear on what I'm suggesting. What I'm telling you is that the Republican Party is no longer the party of business interests. There will be some times where there are overlaps, but the small business community especially, I think, is in particular danger from a policy perspective on the rising populism that is emanating on the right in the Republican Party today. And we can talk specifically about some of those programs, but if you look in California specifically at some of the past election cycles and some of the past policy debates that we have had, it has been the Republican Party that has been problematic in passing things like cap and trade. Some of the things that the energy industry specifically has needed for some sort of relief and framework to move forward to address the political and legal framework that it finds itself in. The challenge was with Republicans. It was not with Democrats. If similarly, when you start to look at transportation investments, desperately and direly needed for goods movement and for the acceleration of business interests and the capacity to actually perform trade, both domestically and internationally, it has been the Republican Party that is the biggest obstacle to these, the passage of investment on behalf of government in this state in order to make sure that those investments are made. And so when you look back historically, there are some interests that overlap between the Republican Party and Republican elected officials and the business community, but increasingly, and I would strongly suggest to you, it will increase at a much faster pace. It will be Republicans who will be standing against small and big business interests as populism overtakes conservatism on the center right, and the Republican Party continues to devolve into a party led largely by people who reject science, who reject the policy of climate change, who reject the basic policies that would bring a faster end to a global pandemic, which is shutting down businesses at an unprecedented pace. And until we ameliorate this as a business community and stand up and make our own voices heard by rejecting this populist element, we stand the risk of being in a lot of danger, a lot of trouble. So having said that, it is very important to also keep in mind that what we saw in the year 2020 with the general election was actually quite typical in terms of electoral results going back to at least 1994. If you look at the electoral results, both in general and midterm elections since the mid-1990s, every election except for 2 have been change elections or votes for divided government. That's exactly what we saw. We saw voters rejecting the cultural extremism, the overt racism, the rising populism of Donald Trump, but at the same time rejecting some of these extremely leftward proposals that would be damaging to business interests and the basic ideation arguably of freedom and liberty that we know as Americans. Things like Medicare for all, which is obviously a concern to a lot of people with the healthcare debate, things like the Green New Deal, which could arguably strangle the entire economy, were soundly rejected below the office of the presidency of the United States. And for the first time, a very good argument can be made that a historically high turnout election actually benefited the Republican Party. It certainly did in California, where you saw 4 congressional seats go back to Republicans after 7 were lost in the midterms. So a vote for divided government, this is also very important. A vote for divided government is not a mandate. It is not a mandate for Joe Biden, and it is also not a mandate for the Democratic Party. It is a rejection, frankly, of both parties, and that is typical of the trajectory we have seen for the past 30 years that is likely to continue as both major parties continue to lose support amongst not only the general public, but their own voter bases. And as we begin to see populist elements emanate within both party structures, we can continue to see this erosion going forward. Again, I believe we're headed for a very, very volatile time politically, unlike anything we have seen in our lifetimes over the course of the next 20 years. And this is going to have extremely direct impacts on the bottom line for your businesses, whether you represent a small enterprise as a small business owner, or whether you're a government affairs or CEO of a large corporation. These are political considerations that you are going to have to address. You're going to have to look for and recognize that we are entering a time that is going to be unlike anything that we have seen probably since the mid to late 1800s. And for the very same reasons, incidentally, larger consolidations of wealth, demographic transformations at an unprecedented pace, and technological change, which is consolidating industries at a rate that is allowing for the mass accumulation of wealth with fewer and fewer individuals, while also leaving more and more people with less economic mobility at the lower rungs of the economic ladder. California, of course, has been complicit in exacerbating this trend. We can debate whether or not they created it. I don't think that government is frankly strong enough to create the forces that have gotten us here, but they certainly have added to the problems. And I think that you're beginning to see that erosion in leadership in a one-party state by the dropping numbers, specifically with Governor Newsom, and what I think increasingly Californians are viewing as a mishandling of the pandemic, some of the unfortunate hypocrisy that we saw at the French Laundry episode, but also with some of the incompetence and mismanagement with unemployment checks going to prisoners, and the massive amount of abuse and fraud that exists in the system that frankly undermines people's preconceived notions and beliefs about a bloated bureaucracy that already exists. These again serve as key characteristics to undermine people's confidence, not only in government itself, but in those that are leading the government. And I say that with one major caveat. That does not necessarily mean that they will reject the Democratic Party and vote for the Republicans. It simply means that we are witnessing an erosion of both major parties. Again, this adds to the volatility in the body politic, and the people most directly impacted are those in the business community, as we find less and less consistency with the framework for both regulatory, tax relief, and the ability to just do everyday business when politicians are reacting to the shifting political winds. So I also want to make very clear that there still remains a very strong downward trajectory for the Republican Party in California. Don't believe the idea that because they picked up 4 seats in Congress, that this is somehow a comeback. I mean, that's a laughable notion. The truth of the matter is kind of like Donald Trump saying we had a 300% increase in employment when they had a 500% increase the quarter before. You're still down 3 seats in the last 2 years, and you're down about 14 or 15 in congressional seats since the mid-1990s. This is a party that is dying. It is a party that is not adjusting. And frankly, it exists only when the Democrats overstep. And while the Democrats are certainly very capable of that, that's no way to build a political party or a political movement. It's simply a way to kind of take a periodic, temporary advantage of political missteps during one snapshot in time. The prognosis then, and I think Ron spoke this to a little bit, is there was a clear, I think, message being spent by people of all political persuasions in the state about a more pro-business attitude as it relates to propositions and ballot measures. Again, in a historically high election, these margins are not something that we would typically expect to see. But what we are seeing is a pushback. I would arguably say that there's sort of a referendum on the policy matrix at both the national and state level that has become too onerous for the average person who's simply looking to live their daily lives. Everything from overregulating Uber to tax imposition by eliminating split roll, and some of the key business decisions were won handily by business, what we characterize as business interests, but I would certainly characterize them a little bit more as special interests. People were rejecting the ideological notion that strangling business would somehow make it better for the average person, the average homeowners, the average business person, the average voter's life. That clearly was not the case. Californians soundly rejected that direction, and I think we're also beginning to see this change in the lives of middle-class voters and even those that occupy the lowest rungs of the economic ladder. And let me speak to that in closing really quickly. There's a lot of national discussion about the break in the Latino vote. Donald Trump, while he did not get a historic share of the Latino vote, he actually increased his vote share since 2016. And 2016 was actually not that good of a year for Democrats with Latinos with Hillary Clinton either. There is a trajectory, which I've been speaking about for years, that is more inclined to support business interests, particularly among US-born Hispanic males. They are much more economically conservative than they are stereotypically or traditionally expected to be. And while this break is causing a lot of concern amongst Democrats, the opportunity for the Democratic Party to reorient its leftward shift in public policy issues also presents a political opportunity to build and cement a larger permanent majority nationally if it is able to move towards a more aspirational, pro-business, pro-economic, pro-job, middle-class agenda for a multiracial world. If it cannot move on those policy arenas, it can expect a continued gradual erosion amongst people of color generally, but Latinos specifically, which for the next 20 years will increasingly become the determinative force in American politics. For the next 2 decades, it will be Latino voters that will decide more and more battleground states, not just in places like Arizona and Georgia, but increasingly in places like Pennsylvania, Wisconsin, the Great Lakes states, and even in Iowa and the Carolinas. The growth trajectory for Latinos in those states will be significant enough to be the decisive vote margins in 2024. The problem, of course, with Latino voters in the Republican Party is the cultural antagonism and frankly, the overt racism that emanated and became very evident during the Trump era, and not only turned off a significant number of younger Latino voters, but mobilized turnout to a degree that is not sustainable for any political party. So the challenge again between both parties, and I would argue this is probably true for California, but it is certainly true nationally, is the party that is able to capture the hearts and minds of an economically aspirational, multicultural middle class, multiracial middle class, will be the dominant party for the next generation. And the Latino vote and the erosion of support for Democrats this year showed that Republicans do actually have an opportunity to get back into competitive position with that vote segment. And we'll just have to wait and see how this story emanates over the next 2 or 3 years. Thank you.
Thank you, Mike. Wow. So I guess the question is, where do we begin, right? I think our 3 panelists have given us great overviews of how they see the outlook post-election. So I guess my first question that everybody's asking, we're in the second shutdown throughout California. And so, it seems like aid from the feds is on hold. So let's start there. Where do you guys feel that will aid come before Christmas? Will the Senate and Congress and the House come to some agreement? Or are we going to be, after the Biden administration gets sworn in, and then maybe also, what do you guys see from the Biden administration to help business? What do you think their position is, and what their philosophy is in regards to helping business? I know Dems are big on helping cities and local governments, and I know that's been kind of the sticking point on a passage of a stimulus bill. So I don't know whoever wants to start.
Well, there won't be a tax relief bill. How about that? I mean, that's one quick one. No, I mean, I'll turn to Mike, but I mean, I would not bet on a stimulus package before end of the year. And it also, as Ron mentioned, it also depends on the elections in Georgia. So that coming down the pipeline. But there are a lot of opportunities. I mean, having the VP, I mean, we're seeing more and more individuals being selected for different cabinet positions. We should think about how to bring down additional resources for California. And hopefully with the influx of a new U.S. senator, in terms of trying to bring down additional resources on that. But one thing I did want to do, and Mike reminded me in terms of the divisiveness that we see across the states, that it's also within California in terms of regular Dems and moderate Dems. So one thing that we see in California, basically, I mean, there's no Republican constitutional officers. There's 8 out of the 40 senators that are Republican. There's 17 out of the 80 assembly members that are Republicans. So in essence, I mean, the Republicans for the state level don't really have a say. However, we're seeing the growth in the moderate Dems. Blanca Rubio is now the chair of the moderate Dems. Stockton, huge change we see in the new assembly member that won moderate Dems. So that's an opportunity locally, kind of doubling up in terms of making sure there's a pro-business voice at the state level and also asking for additional resources from the federal level.
Mike or Ron?
I'll jump in. I mean, if you want. Look, I think that something very significant happened yesterday, and that was Mitch McConnell acknowledged that Joe Biden is the president-elect. The reason why that's so important is because Mitch McConnell recognizes that in about 30 days or so, he will become the most powerful Republican in Washington, D.C. And as a result, the way he outlines the vision for what's going to happen going forward is far more important, at least from a governance perspective, than what Donald Trump is going to say. Now, having said that, I agree that with Ron's comments earlier, Donald Trump's not going to go away. I think he's going to remain a very strong national force, but there are also, for people who do not have the aspirations to be president like Mitch McConnell, in many ways, that could actually be a bulwark for him to actually move things and get things done. We have to be mindful that Mitch McConnell is going to have to defend an extraordinarily large number of Senate seats in the midterm elections. And he's going to have to build something and actually have an agenda to proactively run on as well as run against. That's my opinion. But there's plenty of voices that would probably disagree with that. There's probably a lot of people, especially within the Beltway, who would suggest that purely opposition is absolutely and slash and burn is the way to go against Biden because of the nature, the historical trend line of midterm elections pointing to Republican pickups. I would suggest tactically that there are far too many defends for Mitch McConnell's caucus to simply just say no to absolutely everything. I don't think that's going to be enough. And I think if there are enough seats in play, that having something to actually say they were productive on is going to be more important, despite Trump's henpecking from the bleachers on the outside. So I think that the possibility, to Jose's point, of actually getting a stimulus bill done before Christmas is probably very remote, especially because I don't think the president really wants one. But I think that the prognosis for one happening shortly after the swearing in on January 20th probably increases the chances of some sort of relief and some sort of aid getting done, especially as the vaccine starts to work its way through the health of the population. And I think that there will be a boost, not just from a health perspective, but a needed commensurate economic boost that politically actually will begin to make sense. One other quick point. This will be the smallest margin between both parties in the last 50 years in terms of governance. Nancy Pelosi finds herself with a very, very thin margin in the House, depending on the outcome of the special elections. Either Chuck Schumer or Mitch McConnell will find themselves with a historically small margin in the Senate. Some might suggest, again, that this might be problematic in terms of governance. I actually think it's the opposite. I think these thin margins, and again, the change in the Latino vote, actually gives Republicans reason to support a stimulus package. I think it gives them a reason to support a large transportation bill. And perhaps most importantly, it actually gives them reason for a comprehensive immigration reform plan finally.
Great, thank you. Ron, any comment?
Yeah, the only thing I would add, I think I agree with both of the points. Probably no stimulus bill will be passed, and even if there was one, I mean, there's no direct money that's going to hit anyone's pocket, for the month, for at least, until the next year. So that's important. But I do think one thing that, again, how much can we return to normal, right? Well, we have this active opposition and a Senate that is a thorn at everyone's sides. And what does normalcy look like? I think to me, normalcy looks like a lot of undoing of what Trump was trying to do. And in real world terms, of course, the stock market has been doing exceedingly well, and that helps the top 1 to 10% of the country, right? The corporations, the corporate owned people who are invested. And maybe it helps your retirement funds, but by and large, it excludes a large amount of Americans on Main Street. But one of the places rubber has hit the road economically is on trade. So there'll be hopefully a return to normalcy will mean a lifting of some of these trade barriers that will help farmers all across the country, hopefully. And also investments back to local government, right? Which is huge because in the Trump administration, he's had vendettas. Let's just be honest, right? So local governments, particularly in California or blue states, got less. And we need to make sure that at least if it's going to trickle from local government into local businesses, right? Especially with the pandemic and how that affects things. And I think we've been living in a kind of suspended mode. So the first quarter is going to really say, what does it really look like? And you walk around and local business districts are starting to open up, then they're reclosing and you see boarded up again. The racial tensions, at least in the big cities, has kept businesses boarded up. So normalcy will mean those things go away and people can walk freely and go to those businesses. But short of that, we need to see the governments get an infusion of money. Los Angeles is going to be on the brink of catastrophic failure. I mean, and what that means for businesses, large, small, medium, is catastrophic. So those are the kind of things we need to be looking at. We need to be fighting for. Let's get these businesses open in safe ways, especially now that we have and we're learning more about how this virus is spread.
Thank you, Ron. So let's, Jose mentioned that, there's been some changes in the legislature, of course, right? And maybe a few more mods up there and some new members. So I want to concentrate on what this last election means for legislation moving forward in here in California. Again, put COVID to the side, or is everything going to be tied to COVID? But we've got huge problems: homelessness. We've got affordable housing still on the table. We still have, climate change CEQA on the table. I'd love to get, I think the people would love to see the input, what the elections mean for legislation moving forward here in the next legislative term.
I just want to throw it out for a conversation that we could get into like this, and just for definition. The way I look at the mods are, I wouldn't say anti-union, I would just say less union Democrats, right? They're not necessarily pro-business in all the different manifestations, but they are more moderate and as in opposition to the strong influence that labor has on the progressive side of the Democratic Party. So that's the way I would define mod, as less labor oriented, right? And as that manifests itself. So I just want to throw that as a definition as we talk about, in my opinion, the mods, right? And we saw, the rejection of on the Uber bill, or the Uber legislation, right? That was really a union play, and they wanted to have those folks in as union workers, and it was rejected. So that's what I would throw out as my definition for mods. Not that they're necessarily pro-business. I wouldn't say they're anti-union. They're just not completely strong as some of the other Dems in the more progressive caucus are.
And the additional definition to mods is probably a greater understanding on impact that a lot of the environmental provisions are having in communities. Right now, you're seeing a fight with some of the mods like Cooper out of Elk Grove, kind of challenging the whole EV for all in terms of what that really means for some communities in terms of access and cost. So kind of a better understanding of what the cost is going to be for some of these initiatives and propositions.
Mike, any perspective on the legislative agenda for these guys?
Yeah, let me speak to that. And I'm going to say something a little bit controversial. I'm sure my phone will blow up after this, but I don't believe that there is such a thing as a moderate Democrat. I think it's a bunch of nonsense. And I'm going to tell you why. The reason is because those that have been in the moderate caucus, and they're all good friends of mine, they're overwhelmingly, by the way, people of color. They're overwhelmingly Latino and African American. There's a few white voters. I don't know how many API members there are. Well, everyone calls themselves mod when it's fundraising time, but when it comes to voting, they're not. Okay, and this is very important to understand what's happening in this state. The problem why there is no true moderate caucus is because there's no ideological underpinning of what that means. So everybody can call themselves mod when they want to be in play on a particular vote, or when they want to raise a certain amount of money from certain legislators. That's just the truth. And again, I'm sure I'm going to get a lot of criticism from that, and that's fine. I'm very comfortable with criticism. What moderate Democrats need to do is what I said earlier, is if they genuinely care about these issues, is start developing a policy framework of how they're going to start addressing the income inequality problems, the poverty problems, the homelessness problems, the educational problems, the overwhelming social problems that affect Black and brown people specifically, which is the fastest growing segment of this state numerically, to actually solve our problems. Until that happens, I don't believe there's a moderate Democrat. I don't believe that. You may be less union, you may be more supportive of energy on one or two issues, and that's fine. That just makes you transactional. That doesn't make you a moderate. So a moderate Democrat, as it's defined, needs to start articulating what an economic vision is for California to get us out of this mess. That's what the business community needs as well. It's what the Republican Party used to be before racism made it irrelevant. That's the promise of what a moderate Democrat can be, but it's going to have to articulate on its own what that means. We should be inferring from our own personal perspectives of how that's defined, because the truth is everybody's definition is going to be different. And unfortunately, that's how a lot of politicians want it, because it allows them to be transactional.
Actually, it's really easy to track a mod in California. California has a top 2 election system. So you get the top 2 regardless if they're Republican, Democrats. So we have a lot of dem on dem races. And basically you see who's funding them. And if the more moderate individual candidate wins, by definition, they're the more moderate Democrat than the progressive Democrat.
No, I disagree with that completely.
So let's talk a little bit about some of the changes that are happening, right? We're seeing that Attorney General Javier Becerra is going to go to the administration. There's a possibility that Secretary of State may become senator or someone else. It might be a constitutional officer, but again, these are appointments that the governor gets to make. I really want to focus, Ron, you hit on it when the district attorney in LA said that we're not going to prosecute these misdemeanors anymore, right? And I saw the article too, and I was like, oh my God, what's this mean for business, right? I think people don't understand the importance of the Attorney General of California, but maybe since there's going to be a new appointment, what should business be looking for in that Attorney General? Tough question.
It's an interesting question. Right now you're getting a lot of the criminal justice folks wanting someone that is going to tackle police reform. So I think it's related to what Ron mentioned in terms of what does police reform mean for business. If police reform means that the likelihood that law enforcement will enforce certain regulations and laws to protect the business, then yeah, it'll have a direct impact. But I think that that's not the direct action that the smart justice folks want. I think they want an HG that's more inclusive of community. So that could be business. So I think it might make sense for the chamber to maybe come up with some of the different indicators of kind of what we would want to see the kind of the top cop having and how they would assist business during this time, COVID recovery and recovery overall, and also when there's a little bit of social unrest still out in the community.
Ron or Mike, any comments on what we should be looking for in the next Attorney General?
I think that was a good observation. Full disclosures, we were doing a lot of the independent expenditure work for Jackie Lacey and for DAs because of what we were very concerned about, this developing climate, which is extraordinarily anti-business. Not prosecuting these crimes. Most of these crimes are perpetrated against the small business community. They affect people of color who tend to be increasingly small business owners and are trying to get up that first leg of the economic ladder. So my hope is that there will be, to Jose's point, an attorney general that has an understanding of this. That, look, there are absolutely 100% problems with policing in America. That's just undeniable. Okay, there's a direct racial correlation to what is happening. That needs to be resolved. But taking a hatchet to this and destroying other elements of our community is not a good solution. It's a dangerous solution. So I will be the first person in line to say that we need to reform policing to better address some of the racial inequities which have plagued our society from its inception. I will be the first. But I'm also going to say that the way to do that by not prosecuting crimes is not a solution either.
I think when we look at the new Attorney General, whoever that is, and I think we have opinions who it ought to be, really, it won't be too different from Becerra in the sense that, well, it will be a Democrat. Newsom's not going to appoint a Republican. And rolling back and working with the administration, the new administration on, I think as it impacts California the most, and particularly business, is on economic, environmental enforcement, right? Because that is the big area where the AG will have a say. And, you know, I think Becerra was trying to undo a lot of what was going on at the national level when Trump was denying climate change and all those things. So that is an area where I think the new AG will have the biggest impact in conjunction with the Biden administration, right? The rest of the things, I agree, you know, we need to be vigilant. We need to make sure that there are police protecting business, but those are things that are going to happen within the district attorneys, right? And again, resources that the police need and the district attorney, hopefully, to prosecute those kinds of crimes and not let them go, you know, small petty crimes, quote unquote petty crimes, that aren't petty to the person who's behind the counter or who owns those small businesses, right? The question I want to pose to this panel is what about the Republican Party in California, right? And what, you know, you saw Morlock, the senator who was I think one of the few senators in California to really embrace the Trump policies. But then you also have Janet Nguyen, a Vietnamese woman who in Orange County. Orange County is becoming more and more, quote unquote, moderate. It's one of the few contested Democrat-Republican areas in the state. I think during the Clinton administration, Obama was going more Dem, then it started to sweep more Republican. But, well, I mean, yeah, I think it's worth, because traditionally the Republican Party has been the party that the chambers have been more aligned with and all that. And now, you know, where do they find their source, I guess, their party? Where are they going to be comfortable, I think? The California Republican Party is in complete disarray and has been for a while. So that's more of a question. And also,
Jose, any response to Ron here?
Well, I mean, there might be. I know that Mike doesn't like the mods, but there is going to be a wave of super progressive candidates trying to take office. And that'll cause more moderate Democrats to maybe align with more business friendly. In LA, I mean, we saw kind of David Rue, city council, I mean, race a couple of races. I'm getting calls from some city council members also saying, oh, shoot, there's going to be a high progressive running against me. I mean, can I get in front of the LA chamber kind of thing? And so, I mean, this might be the whole AOC effect in terms of, I mean, you have this divisiveness that's going to happen even within the Democratic Party. That now you had AOC kind of combating Trump, he's gone. Now she and other colleagues are going to start combating Biden, and they're going to create this kind of, if you're really progressive, this is the way to go. So, I mean, I think that it behooves the chamber to come up with these principles and start challenging some of the more conservative Democrats in California and seeing how they can align with those principles.
Mike, any response to Ron's inquiry?
Well, look, I'm not hopeful about the Republican Party's survival. Like I said, what we saw was anomalous because there was a rejection of the extremism of the left's policies. But I think that's the difference between where Jose and I sit, is they weren't voting for moderate Democrats, they voted for Republicans. Okay, so this ideological rift between moderate, quote unquote, moderate Democrats, and again, I still have not heard a definition of what that is. Everybody, you know, it doesn't mean anything. It's a meaningless term. Just being not progressive does not make you a moderate. I don't know what that means. So I think the attempt is to try to be transactional on a specific interest. The way moderate Democrats can actually form and be successful is, again, by articulating what it means economically. Okay, until then, you know, it's a case-by-case basis, which in the same way that will not work for the Republican Party, it will not work for quote-unquote moderate Democrats. You have to articulate what that vision is and what you stand for before you can work in coalition. If you talk to anybody in the business community today, they are solely focused on trying to identify those individuals that can help them in the right area on their keen area of interest. It could be energy companies that are backing people in primaries. It could be the pharma companies doing the exact same thing. But only very rarely are those individuals completely lockstep on all of these issues, which is exactly my point. Each lobbyist in California that represents these interests is looking for individuals, usually on the right committee, to help them take one tough vote to prevent these votes from getting to the floor. That's not ideological. That's tactical. That does not mean, it's not make you moderate. It makes you a smart tactician legislatively. And that's the problem in California, is until there's actual articulation of what people stand for, you're never going to get out of this morass. You could have 100% Democrats in the legislature with the exact same problem. And that's why everybody was talking for the past 10 years about the growing moderate Democratic caucus. Tell me, where's the list of the members of the Mod Caucus? I want to see that list. It doesn't exist, and there's a reason why it doesn't exist.
Our studio in Stockton tells me they have some questions for our panel, so I will, if the team is online, what's our first question, guys?
The question is for Mike. I agree with Mike Madrid that we are seeing a pushback on policies that are exceedingly far left and liberal. The business community is facing financial ruin from COVID-19 in California. What do you think the fallout is going to be for politicians like Governor Newsom and Nancy Pelosi? Do you think the recent efforts to have them ousted from their positions as having legitimate momentum?
That's a great question. I do believe that there is momentum, but I do not believe it'll be sufficient, for example, to see them lose their seats. This is why it is so important for the business community to do two things. First is chambers must unite and work together to articulate what an economic agenda for Democrats means to get people to sign on. If we're serious about having moderate Democrats, then assist them and help them in articulating what that means from a philosophical standpoint. If the business community were doing that, it would change the entire dynamics of the governance for the state and provide extraordinary relief for the business community. But that requires the second piece, which is you have to recognize the Republican Party is not your friend, and their existence is actually hurting you now, because when you align with what Jose said earlier, 17 members in the Assembly and 8 in the Senate, you're aligning with the smallest, most fringe, irrelevant, extreme groups who are giving voice to your cause, and it makes it easier for Democrats to dismiss you. Abandon them. Make them come to you. Do not go to them anymore. The way you create a center is by helping it within the Democratic Party and forcing Republicans who want to remain relevant to abandon their populist, crazy, extremist base and come back and support your positions. That's why Morlock lost, by the way. Whatever you think of Morlock, he's one of the most extreme, crazy, ridiculous members in the Senate. He deserves to lose, and he lost an Orange County seat. And if you can't be, as a Republican, be moderate enough to understand how to be pro-business and pro-trade and support the business community, your chances of existing are extremely remote. So there needs to be a center, and the way you build it is by actually giving moderate Democrats a framework to actually support a philosophy of governance, and they don't have one at the moment. It's a good question.
Another question from the studio?
The question is for everyone. It's no secret that doing business in California is tough. Do you see any action / proposed legislation in the California legislature to assist in the recovery of small business? Aside from loans, how can we assist in advocacy?
So I'll kind of kick it off. I know, we're going to be kicking off here in a couple of weeks the $500 million grant program that the governor put together. And our chambers throughout the state will be helping us do outreach on that. We just got word that the proposal that we are tied to with Lindustry got approved by the GoBiz. So we're looking forward to that. I know that's one thing that's on the way. That's for the smallest of the small businesses. But I think it's a good question, right? What do you guys think that the legislature needs to do and can do to help our small businesses? Jose, Ron, Mike?
Well, one thing they need is ideas. And so, I mean, that's why I go back to what Mike said. I think we should definitely be laying down some principles, some thoughts for some individuals in terms of how to really help and have an alliance with the chamber. Loans have been top of mind. There's a couple of discussions about possibly tax relief, tax credits, but nothing major. I mean, in terms of the devastation we've seen to some of the businesses, I mean, short of also, I mean, infusion of capital directly to those businesses, I mean, we're not seeing much. We're going to see something around broadband. We're going to see something around housing. We're going to see something around in the energy sector in terms of kind of building up that infrastructure. People are already talking about fast tracking state projects in terms of infrastructure projects, but no real ideas that are focused on our neediest businesses.
Ron or Mike, have you guys any ideas?
Well,
anything?
I'll be very specific in some regard. I think when you look at small businesses, everyone has a business, right? A physical business that they've been paying rent, or their landlord is trying to collect rent for, right? And I think because we've been suspended in this quarantine or lockdown, you know, the landlords have not given waivers. And I know there was a piece of legislation that did not go anywhere. There was something in Los Angeles to have relief for small business owners on rent. You know, when you say to your landlord, hey, how can I even go into my office? Oh, you can't. Well, why do you want me to pay rent? You get an obnoxious letter, your rent is due, your rent is due. That's something that's very specific. I think we need to kind of look at what's going to happen. We're going to get from these progressives in the cities, in particular, the larger cities, very crazy, outrageous bills and whatnot. But there are some that we can support and get around, right? I think there ought to be something around rent and what that means for businesses and small businesses. If it's not a direct grant to business owners, then you know, it ought to be passed through the landlord, and the landlord, there should be some issues through the banks and should trickle all the way through. Why does the small business owner be the one stuck with the check? And right now we are, and that's the truth, right? Come January, all of those things are going to come to roost. I don't know what's going through the legislature in terms of bills in that regard, but that's something that we should directly be looking at as a small business community.
Mike, any comment?
Well, real briefly, I mean, I think Ron's right. I think there's a couple of immediate ways where you could provide immediate relief through tax deferral, through temporary tax suspension. You could probably work on everything from workers' comp to, you know, there's a lot of immediate ways to provide temporary relief, which would affect the revenue stream for government. But I think right now the immediate triage needs to be protecting businesses. Because if they go away, they're not coming back. That you could just see downtowns hollowed out completely. So I agree with that. Having said that, we have to also recognize that that's a Band-Aid, right? That's getting us through the COVID period. In order to have some of these businesses that do stagger through this and stumble through this, we're going to have a longer term framework for economic success. And that's going to take a complete revamping of our economic framework for how we view small business specifically. Large business, I mean, things are bad, but I'm less worried about them. They can influence legislation in a way that the small business community cannot. But like I said, I think the way that we ultimately get there, and you probably heard people say this before, is going to be through direct political action from your local chapters. Some of your groups do this exceedingly well. And the more that everybody engages in this and articulates this as an agenda that's necessary for the fastest growing segment numerically of the California electorate, that's how we're going to see relief. Look, folks, these issues of the economy, when we talk about them being about business versus labor or business versus the environment, you're going to lose 95, 98% of those fights. So stop talking about it that way. Talk about it in terms of economic justice. Talk about it in terms of social equity. Talk about it as a civil rights measure. Start using the language of the left, because you cannot accomplish what the left is trying to accomplish in terms of justice and equity without economic justice and without economic equity. So let's quit fighting these fights the same way when we know we're going to lose 98% of them. Let's start winning by addressing some of the social equity problems that people are trying to accomplish through economics.
Changing the narrative is key, but there's also an opportunity in terms of really tackling all the regs that are plaguing some of the businesses and looking at the impact for small business and micro enterprises. Similar to how in housing we have SECO exemptions for affordable housing projects. I mean, and nonprofit development. I mean, I think that it is a good time to start looking at small business, micro enterprises, and seeing kind of what kind of reform we can propose to some of the business regulations.
Thank you. Next question for the studio.
Lastly, this question is for everyone. For the small business community, what can we do to prepare ourselves and our businesses for prolonged stay-at-home orders? And what are points of wisdom on resiliency and survival?
That a little bit, and I apologize for those involved in the retail space, because this is probably a little bit more difficult. But what I will say is this: innovation has always been the key for business survival. And we have been through difficult times and difficult times before, but if your industry is being impacted, you have to recognize that a vaccine is not going to take us back to normal. Things have changed. The commercial real estate industry has changed forever. It's never going to be the same. Most white collar work, a new economy work, and high tech work has changed probably forever. I don't envision that we're ever going to go back to the same type of workspaces that we ever had. COVID simply accelerated some of the trends that we were expecting to happen in 10, 15, and 20 years. They're here now. I ran a presidential campaign from downtown Sacramento, okay, during COVID. That's never been done before, but it didn't matter where I was at. I could have done it anywhere on the globe, because most of us who are working remotely can do it anywhere on the globe. So when you recognize that the whole business model and the whole framework of the way we approach business has changed, it's not a matter of surviving till the end of the pandemic. It's recognizing that the entire social structure has changed, and build your business accordingly. Adjust to that reality, because if you're just trying to survive this, you're making a mistake. You need to seek to thrive beyond this.
Anybody else? We're coming up to the end here, but I have one final question. And what I'd like from the panelists is just the one topic, right? A couple of words on what do you think is the most important, outside of COVID, of course, what do you think is the most important legislative issue the California legislature needs to address this session? The most important from each of you.
The economy. I mean, no question. The collapse of revenue, I think, is going to be extraordinary in terms of the budget shortfall we're going to be looking at. But things are not just going to bounce right back. That we have lost so many small businesses that are the engine of this industry, and the lack of capital to reassess and get back to. It's also not going to be a quick rollout. It's not going to be like, the day World War II ended, everybody's out in Times Square, hugging and kissing and celebrating. That's not the way this is going to end. It's going to be a very slow rollout and slow build up back to whatever range of normalcy we're ever going to get to. Business has changed forever. There's going to have to be some sort of economic plan to bridge some of these small business enterprises specifically as the first order of business, because if that doesn't happen, the recovery could not just be a year, it could be 4 or 5 years.
Ron?
And related to that, and just digging down a little deeper, is the workforce in terms of, the essential workforce. What jobs are not coming back? We were already having this discussion about automation, and then I know there was a pushback from unions in terms of, well, we still need these type of jobs. But we're seeing that, no, these type of jobs are not going to come back. So what does that mean? And so the economy and a deeper dive in terms of that preparedness and what it means for underserved communities, and which links back to all the education work that the chamber has also looked at as well.
Ron, your one issue?
Yeah, the only thing I would add is really, here's the fundamental difference in terms of how government can help. Unfortunately, California and the local governments can't print their own money, right? The federal government will print a lot of money and needs to print more money to deal with this crisis, because as everyone's alluded to, and Mike articulated, this is going to be a slow recovery. It's not going to be a snap the finger and we're back to normal. What's going to keep the economic recovery survivable? And that's a direct investment from the federal government. And who gets that money? In the first iteration, it was the large businesses, even though they talked about small businesses. It was the large businesses that got help. Even Gavin Newsom got a bunch of PPE loans. So, you know, we need to track on that. How do we make sure, and how do we hold our electeds accountable when there is stimulus? And this next stimulus bill is not going to be the last, nor should it be, because if we're in a prolonged economic recovery, it's not going to be enough to get the businesses because they need the direct rents. Then we need to spread the pain. There is going to be pain, but why is it always the small business owner that holds the card? Like, you know, as a tenant, you know, we're paying rent. We have to pay rent. They tell you we can't go to work, but yet you pay rent. Then your landlord says, pay us because we're getting squeezed by the banks. Well, then you got to give the banks relief and give us relief, and so that we're not the ones holding the bag. And historically, that has happened in America, and that's what's going to happen unless we're vigilant. And then the third thing I would say, and this is why I applaud the chamber for even having events like this, and Jules' effort, is that we need to have a better voice for advocacy, right? And we also have to understand that as a small micro business, our voice isn't necessarily big business. And that's the one, even though it goes under the rubric of a small business, 50, 100 million, when you look at who got PPE loans, there was a lot of fraud, and there are a lot of businesses they didn't means test it. And so a lot of people put that money in the CEO's pockets. So we need to be vigilant. We need to strengthen the network of all the Hispanic chambers working with other small businesses so that we can have an advocacy voice for what's going to be in store. But hopefully we'll all survive, and look forward to helping you in that regard.
Well, thank you, Ron. Thank you, Mike. Thank you, Jose. A lot of information, right, for us to digest. A lot of things happening. You know, they used to say, you know, we're in a new normal, but, you know, there's nothing normal about these times as we move forward, both from a economic perspective and from a political perspective of everything that's going. I know we didn't get to answer all the questions that we have. I think we have your email, so if you ask a question, we'll maybe Mike and Ron and Jose, I know are usually pretty good about answering those questions, you know, off the side. But I thank them all, taking time out of their busy schedules. Ron taking time out of his vacation there in Hawaii, so we'll let him get back to enjoying the sun there. And Jose from Southern Cal, and Mike up here in Sacramento. Thank you guys again for participating.
Can I make one last comment though, since we're talking about Hawaii? There is a program you can find online where they're going to pay business owners to come to Hawaii. They will pay for flights for you and your family and discounts as well. If you're interested, I could give everyone the link to that program. I'm not on that program. I'm not going to stay that long, but it's for business owners to come to Hawaii and those that can work remotely. So anyway, I wanted to put that plug out there.
We'll send it out. That's great. But again, I thank the San Joaquin County Hispanic Chamber for their leadership in really bringing a session like this to the public, and you know, talking about the economic outlook, but also more importantly, the political outlook and advocacy. These are important things to our chambers that, you know, I know that our leadership feels it's important to all our chambers throughout the state. So thank you to San Joaquin County Hispanic Chamber for their leadership in that area. And thank you, Lisa, for your leadership and putting this together and bringing us together and inviting us to participate. With that, I'll turn it back over to the studio. Thank you.
Please welcome back to the stage Lisa Vela from the San Joaquin County Hispanic Chamber of Commerce.
Thank you. This has been a very informative discussion, and I want to thank Scott Anderson, and a special thank you to Bank of the West for their partnership Allow me to thank Jessica Chancellor of PG&E and our panelists, Ron Wong, Jose Atilio Hernandez, and Mike Madrid for providing great insights today that can help our businesses anticipate how to operate efficiently during these unprecedented times. Thanks again to event sponsors. It is their continued support that makes it possible for the San Joaquin County Hispanic Chamber of Commerce to provide the programming you have all access today for free. Before we depart, I'd like to give a huge thank you to the team at San Joaquin County Office of Education for their work producing today's event. Johnny, thank you to you and the Coach Stack team. And last but certainly not least, to my co-hosts today, the California Hispanic Chambers of Commerce and Julian Canete. The collaboration of Julian and his team was instrumental in making today's event a great success. Thank you, everyone, and enjoy the rest of your day. Thank you.